Good Friday morning, everyone. I'm Brad Smith alongside Jared Blickery. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, concerns about the banking sector continue to weigh on markets worldwide. In Europe, Deutsche Bank shares tumbling as the cost of insuring against default, that's jumped. And with investors still wary in the aftermath of Credit Suisse's turmoil, UBS shares also slipping after a Bloomberg report that it's under investigation by the DOJ for aiding evasion of Russian sanctions. This as Treasury Secretary Yellen assured lawmakers and regulators that they are prepared to step in to help U.S. banks if needed, clarifying remarks that she made earlier this week. Second thing that you need to know, a wobbly end to the week for markets as investors remain wary of the health of the banking sector. The Stoxx Europe 600 index sliding for the second consecutive day. That's been pulled down by bank stocks. U.S. futures wiped out earlier gains from the week. This comes as a Citigroup note reaffirms an underweight call on U.S. equities. Analysts saying an impending recession puts U.S. stocks at a risk of underperforming. All of this has more American investors feeling increasingly pessimistic, according to the latest survey from American Association of Individual Investors. And the third thing that you need to know, a brutal end to the week for Block. Shares continue to slide after tanking yesterday thanks to damning accusations of exploitation and fraud in a report published by short sellers at Hindenburg Research. The mobile payment company is accused of overstating legit user counts and allowing fraud and criminal activity to thrive on the Cash App platform, its subsidiary. CEO Jack Dorsey saw his net worth fall by over $500 million since that report dropped. Now, Block promised to work with the SEC to explore legal action against the misleading, as they classified it, Hindenburg Research. Getting back to the top thing this morning, concerns in the banking sector, they continue to weigh on global sentiment. Deutsche Bank shares plunging right now. And this also all comes as Treasury Secretary Janet Yellen tried to calm investor fears around the economy. Let's bring in Wall Street Journal reporter Ben Eisen for the latest here. And Ben, there's been a flurry of news, even new news this morning that's come out, especially around Deutsche Bank, as we know that some of the concerns continuing there, default insurance, that's spiking. And so with all of this continued, where does this really set us up for the reassurance or the attempted reassurance of confidence that we've seen among regulators and lawmakers into the banking sector?
Yeah, you've really seen panic kind of ebb and flow over the last couple of weeks as we've seen this banking sector turmoil play out. And now it's picking back up again. And you know, what we're seeing today with Deutsche Bank is there's not that much of a catalyst, it appears, for this stock to drop, but investors are really kind of picking up the weak links in the financial system. And, you know, we've seen Deutsche Bank have troubles for many years now. And now investors are sort of turning their eyes to this bank. If you think back to Credit Suisse and everything that happened with it over the last week, it didn't take much to kind of get the stock to start dropping and kind of leading to everything that played out over the last week. So now Deutsche Bank is sort of investors' focus of the moment.
Ben, great to see you here. Just wondering, I mean, you've been writing about this for the Journal, all the different facilities and the potential rescue missions that the banks have been organizing, that the feds have been organizing for the problem here. And in one of your reports, you liken this and you throw back to 1907, and that's when John Pierpont Morgan, the original J.P. Morgan, organized a rescue for the banking system around the panic of 1907. And we've seen banks come together before. I could go back to 1998, long-term capital management that was orchestrated by the New York Fed. And then we have Jamie Dimon, which you're writing about, or which you have written about, orchestrating a $30 billion deposit kind of bailout for these banks. So clearly there's something big happening here, but we haven't really seen huge shoes dropping, at least in the U.S. Just wondering what your sense is, how this compares historically to some other bouts of panics that we've seen in the U.S.
Sure. Well, you've really seen in the U.S. there have been huge coordinated efforts to try to stop this. What we've seen start here in the U.S. from becoming, you know, an even bigger panic. Right. You did see some of the big banks step in with First Republic Bank, which is another one under pressure, and try to kind of stop stop that bank from falling further and sort of draw a line in the sand and say, hey, we're not going to let this bank fail. You've also seen the Treasury Department has, as you've said, put some of these facilities in place, and you are seeing banks in the U.S. Starting to use these. The latest data that came out yesterday showed that more banks are using the new facility that the Treasury Department has put in place, that the federal regulators have put in place to basically borrow against the bond holdings that they have lost a lot of money. So in the U.S., you are sort of seeing signs that some of the stuff may be kind of plateauing. It's obviously very early to say what will happen, but as they say, when the U.S. sneezes, Europe catches a cold, and that's when you see these sort of worries jump across the Atlantic. Perhaps some of these issues can kind of take on a life of their own.
The credit default swaps at Deutsche Bank are far less than that of Credit Suisse, and we had watched and seen what played out with Credit Suisse and the eventual fire sale there. But even as we think about how banks got so flat-footed, caught so flat-footed, how did that happen from your perspective?
Sure. Yeah, I think it's a good point. And just to note, credit default swaps can be very illiquid. It's not necessarily the only thing to watch when you're deciding. I mean, when you're trying to figure out what's going to happen to a bank. But that said, this all sort of started with Silicon Valley Bank, which sort of did start with a big drop in its stock. They decided that they were going to sell some shares and that they were going to take a loss on part of their bond portfolio on March 8th. And then on March 9th, the stock dropped 60%. And there was just so much panic that was created around that bank that it actually did start to cause a run on the bank. So, sort of what we've seen over the last couple of weeks is the stock itself may not necessarily be a problem, especially for a U.S. regional bank, unless you start to see deposits flow out in tandem with that. And while deposits have moved around a lot over the past couple of weeks, the question of is there going to be a run on another bank is not necessarily tied to what happens with the stock or with the actual trading of the securities. So it's hard to say that what necessarily will happen with any other bank.
And Ben, we have time for one more. I want to get to the heart of the problem here. And for that, let's go to the Wi-Fi Interactive. You take a look at money markets, mutual funds. They've been attracting funds at an amazing clip. Here's Jim Bianco, just tweeted this morning. Assets increased $117 billion last week. That's after $121 billion the week before. And here's a graph. This shows the incredible surge in assets into money market mutual funds since the Fed began aggressively raising rates. And now we got these funds that are offering 4.75% or thereabouts, the low end of the Fed's target range here. And meanwhile, savings accounts are paying 0.5%, sometimes 1% on the high side there. I'm just wondering, in the conversations you're having with some of your sources here, do people worry about this problem that there's a fundamental mismatch between the amount that depositors are being paid and that's why we're seeing this huge capital outflow from banks in the first place?
Absolutely. I think, even going back a couple of months, there were a lot of questions about why have deposits not repriced in the way they have, and why haven't depositors been taking their money out of these savings accounts, these checking accounts that yield so little, and putting them into higher yielding accounts. And, you started to see that happen. It hasn't happened sort of at the pace that maybe some people expected. But now that we sort of have this big, broad conversation happening nationally and globally around, what's happening with deposits, I think people probably do have a better sense of what they're earning on their deposits in a bank account versus what they're earning in a money market fund or a higher yielding account. So, it is possible that you start to see, everything that's happening be a bit of a wake up call for people to kind of come in and understand, yes, I can earn more on my money right now.
Yes, they can. And I think people are exploring that option as we speak. Thank you for that, Wall Street Journal reporter Ben Eisen. American investors are not feeling good, and recent market turmoil is to blame. And according to the latest survey from the American Association of Individual Investors, bearish sentiment, it rose to 48.9%, remaining unusually high for the fourth consecutive week. Bullish sentiment, the opposite, was up slightly, but still only hit 20.9%. It remains one of the lowest readings in the survey's history. And Brad, I think this is, first of all, this is a contrary report. The AAII bullish and bearish surveys, you want to see people, you want to capture the readings at extremes here. Yeah. And I'm going to put a chart on the S&P 500. I'm going to go back over a year and show what some of the readings were at previous extremes here and why this report is actually somewhat bullish. So we've seen, we're just coming off some very low levels for bullish readings, and yet equity prices, we saw that big low in October. They remained relatively elevated since then. And so investors are not believing the rally so far, and they are not bearish to an extreme extent. So I'm not seeing the catalyst here for a potential reversal either to the upside or the downside here. I think in terms of this particular report, we're not seeing the contrary readings that we would normally get at extremes. But I do find it encouraging that we don't see a lot of bullish enthusiasm, despite the fact that the market overall has not gone down, banks notwithstanding.
Yeah, no, you make a great point, and this report had also kind of echoed some of that same sentiment, saying that historically the S&P 500 index has gone on to realize above average or above median returns during the 6 and 12-month period following that unusually low reading for bullish sentiment and the bull-bear spread there. So that one of the points that you were getting at there. And then even as you think about how their special question, as they called it, was asking the members how they would describe the current valuation of stocks. And as we've continued to have day after day, time after time again, these discussions with portfolio strategists or fund managers just looking at where the valuations currently stand and if they still need to come down further. We knew that coming into the start of this particular earnings season, the valuations and the earnings expectations still needed to, in tandem, come down. And so with that, the responses from the members here of this survey, only 13.6% of them saying stocks in general are fairly valued right now. Many of them still saying that stocks in general are overvalued. That's about 25% of the respondents there. And then about 40% of them saying, you know what, it's mixed at the end of the day. Valuations, they're mixed. Some stocks are expensive, others are cheap right now. And so at the end of the day, it's for some of the larger moves that we've been tracking, especially over the course of as we round out this first quarter of 2023, just next week. My, how that's gone by fast. Yes. As we round out this first quarter of 2023, even the rebound that we've seen in some sectors is really just coming off of the move lower or concerted fashion in a move lower that we had seen during 2022, and a little bit of nibbling or setting some longer positions that we've seen start to emerge, especially in one sector that I know is near and dear to both of our hearts in semiconductors and tracking that over.
Yeah, we'll track the semiconductors in a little bit here. Nothing further on AAII.
Yeah. Let's also talk a little Block though here on the day. There's a lot to talk about there. Block shares are extending their losses this morning. This is a day after the company became the latest target of short seller Hindenburg Research. The report alleges that Block has been misleading investors by overstating user numbers with fake accounts and that it's ignoring fraudulent payments. Now, Block condemned the report, saying that it is planning to work with the SEC to take legal action against Hindenburg. Block CEO Jack Dorsey saw his net worth fall by over $500 million since that report dropped. On the dip of the Block stock, ARK Invest's Kathy Wood bought up about $21 million worth of shares of the company. We've got you covered on all things Block, much more later on in the show. Well, getting to today's morning brief, stocks rallied back yesterday following some Fed-induced losses on Wednesday as investors are weighing Powell's hawkish inflation-fighting comments while also keeping in mind that the Fed is entering a wait-and-see mode, believing that its work is nearly done. You can read all about this in today's morning brief up on the Yahoo Finance homepage. But for more, let's get on over to Jared Blickery standing by at the Wi-Fi Interactive. Jared.
Here we are. Remember data dependency? That's a phrase that we haven't heard in a while, but it looks like the Fed is moving back to that. And we've seen this breakneck pace of rate hikes over the last year, increasing them by about 500 basis points, a huge amount for 1 year. And I just want to point everybody to the Wi-Fi Interactive here. Over the last 9 days, we have seen some incredible runs in the tech sector. The Nasdaq 100, if you take a look at these left-facing stocks here, we see a lot of the mega caps with some outsized gain. Alphabet up 16.5%, Meta up 13%, Nvidia up 18.5%. The bellwether Apple stock only up 7%. And it looked like tech stocks may have room to run here based on the fact that the Fed is kind of in a pause mode, but not really, waiting to see what happens next. Interest rates, meanwhile, have come down, and this has fueled the growth trade. But what I want to point out there is that a lot of these trades have reached interim highs here that are a little bit extended. Apple, I think, is a great example. You take a look at a one-year chart of Apple here. Actually, let me put this to 2 years so I can draw some longer-term trend lines. But here we have right towards the top of this line here, and we also have a trend channel. Suffice to say that Apple has reached an overbought status with respect to its RSI, not shown here, and into these potential resistance levels. So Apple potentially at an inflection point. And also I want to point out that the markets overall, you take a look at the Nasdaq, the S&P 500, we'll do the Nasdaq right here. Nasdaq has been in a trading range over the last year. And here's some candlesticks so we can see the price action a little bit better. I'll put the lines back, and you can see here is a range in the Nasdaq, basically 10,500 to 13,000 there. Until we break this range, nothing has really changed. And you take a look at what the Fed has typically done, and what the markets have done at this phase in the business cycle. If we are expecting a recession, just keep in mind we don't usually get the big low until we're actually already in the recession. And we don't think that's happened yet. So a little bit of ways to work here until we get back to those highs, Brad.
Well, that perfectly tees up this next conversation, and we'll keep this going. The Fed raised rates by 1/4 point while suggesting that some additional policy, that firming might be necessary. Our next guest expects that rate hikes at the May and June policy meetings are to come. Let's welcome in Max Kedner, HSBC Chief Multi-Asset Strategist. Max, if you're expecting rate hikes at both of those meetings, to what extent would we be looking for any type of rate hike? Is it both 25 at both of those meetings? Is it a 50 and a 25? What say you?
No, it's probably 225s. I think it probably goes back to what you just mentioned. It's, the Fed is returning to getting data dependent and perhaps going a little bit away from, those recent wobbles we've had in the banking sector, of course. I would say, just to what you guys were just talking about, it is somewhat astonishing, I would say, when we look at, for example, at the S&P over the last 10 months, which is literally just after the Fed started raising rates, first 25, then 50, right? If we look at the last 10 months, the S&P is flat, right? Nothing's actually really changed. So it's quite interesting to see how that stacks up with sentiment and positioning, which you already mentioned with the AAII survey. And I would stress also that it's not just survey-based sentiment, right? When we look at our sort of shorter term sentiment and positioning indicators, whether that is on the options market, whether that is technicals, right? Whether that is VIX futures curve, or really a range of other short-term sentiment and positioning indicators, they all tell us, look, people are already pretty grim, right? Despite the level of the S&P and the Nasdaq not really falling off, sentiment is already sufficiently grim that you can actually stay constructive.
I want to talk to you about the U.S. dollar index and just in general the U.S. dollar. If we go to the Wi-Fi Interactive, I have a longer-term chart of the Dixie, and of course this is kind of an older weighting of the U.S. dollar index, but nevertheless very looked to as a bellwether. You can see the incredible run up that we had from 2021 into the latter stage of 2022, came down, and the dollar weakness was associated with a risk on trade. It facilitated that. Just wondering what your outlook is for the dollar given all this volatility that we've seen.
Yeah, I think the dollar is still probably broadly on a downward path because two things. Number one, if we look at the dollar over the last 2.5 years, it's actually been broadly really tracking short-dated rate differentials, right? So basically, US rates, how they were faring against European rates and against really a range of other global rates. So does the US pay more at the front end than other jurisdictions? And that has really shrunk in the last couple of months, right? And really the last 6 months. And unless you expect that that is going to be incredibly on the rise again, so unless you expect that the Fed is going to go, I don't know, to 6.5, and all the other central banks remain put, then there is, I think, a basis for a stronger dollar. But that looks heavily, heavily unlikely. The other thing, the second factor, is what you just meant, that risk on, that risk on sentiment. When we look actually at G10 currencies, so the currencies of the largest economies worldwide, if we look at that over the last 2-3 months, they've been more and more correlated with those risk on, risk off gyrations. So we do expect, as perhaps some of that volatility that you just mentioned, as that perhaps subsides in the next couple of weeks, that is giving sort of the all clear to a short dollar trade once again.
Max, for anyone who's continuing to try and parse through what the Fed is saying, what Yellen is saying, and then additionally what the ECB is saying this week, what the UK boards have done in terms of their own rate policy as well, all of this considered, people just want to know how to set up or best position their portfolio, knowing that it's not just about a U.S. rate policy and rate strategy. It also is about what companies are going to be exposed to policy that's happening elsewhere around the world. So how can they go about that positioning?
Yeah, look, perhaps the first comment, I think, from what you just mentioned around, what the Fed is saying, what the Treasury is saying, what the ECB is saying, the Bank of England. Look, I think less is more, right? In these situations where it's highly uncertain, I question perhaps what value add it is that Chair Powell, for example, on Wednesday during the press conference mentioned the word uncertainty 6 times. We know, right? We know things are uncertain. You don't have to put additional fuel to the fire. That doesn't help, right? It really doesn't help. Or it doesn't help that, every 2 days we get another sort of news flow on the deposit insurance. So that certainly doesn't help. And that's very, very, very discouraging, I think, for longer term investors, right? Because what can you do if yields go up 20, 30 basis points one day and then they go down the same amount the next day? I think where you want to be positioned now is probably not anymore in the growth part of the equity market, right? So what you guys were talking about around some of the growth and the tech stocks really being extended already, I think that decline in yields is probably starting to come an end. And that means also the strength of growth stocks starting to come to an end. That means more rotating into value. It means also rotating into emerging market asset classes. And it also means rotating into high yield credit. Because if you actually say, look, things are broadly okay. Our leading indicators, for example, are picking up. Our earnings indicators are picking up. So from a macro and a bottom up perspective, things are kind of okay, right? And as long as the equity market, as long as we remain in this sort of a trading range, that's actually pretty good for carry positions, right? For high carry positions such as high yield credit.
So if things are kind of okay, just wondering what your recession outlook is here, because if we're talking about you liking the high yield market, we're not talking about 2008 banking crisis on the horizon. What do you think is in store for investors on the economic front later this year?
Yeah, I think the recession debate won't come before the second half of the year again, right? I don't think so, because let's remember what we will get the next couple of months, particularly in the US, is we'll get hugely disinflationary effects from supply chains, so from goods prices, from energy prices. So it's not unthinkable that we've got a sort of 3%-ish inflation by June, July in the US, this summer. So that means perhaps a bit of a rebound in consumer sentiment and consumer spending. That actually means things will become better before perhaps they become worse. So I do think the earliest we'll probably be talking about recession again is sometime in the second half of the year, or perhaps into 2024. But for the next sort of 4 or 5 months, I think we're fine. I think we're actually on the other trajectory, that actually things are picking up and becoming slightly better now. And that's not only in the US, it's also in Europe and also in China.
HSBC Chief Multi-Asset Strategist, Max Kettner. Max, thanks so much for the time and the insights today. We appreciate it. All right, guys, and coming up, Express shares are sinking pre-market after net sales slumped 14%. We're going to discuss that, plus have the opening bell on Wall Street. That's next. We're taking a look at shares of Express, ticker symbol EXPR, lower after missing revenue estimates in its latest quarter. The retailer saw sales decline while expecting margin pressure and recessionary environments experienced in the back half of the year to continue. Taking a look at the actuals versus the estimates, it was a miss on both the top and bottom lines here, as we mentioned. And a few things to really call out here. Number one, of course, was the miss on the net sales. That declined by about 14% year over year. Comp sales for retail, that was down by about 15%. And inventory, that was up by about 2%. What we have heard from many of the companies, whether it be Nike or some of the retailers in the different elements of kind of footwear and apparel, is that there has been inventory improvement as compared to last year, which was, of course, the big concern. And so now it's a larger question of what some of the trends are that they're looking at in their consumer to say that, hey, they're still going to come out and spend, even as discretionary spending has certainly taken a bit of a hit on a household or even individual level as well.
Yes, this company, let's not forget that it was a meme stock, and this is a consumer-facing brand, first of all, but I think this just kind of highlights the execution strategies, the haves and the have-nots that we've seen emerge from the pandemic, and unfortunately, Express is a have-not, it looks like, just based on this. You said comp sales down 13%. You look down to the guidance here. First quarter, they're expecting comparable sales of negative low double digits. They're expecting a loss per share of 70 to 80 cents. I don't see anything really constructive here. In 2023, their outlook reflects improved sales trends through the year. Okay, well, improved sales trends throughout the year. If they're trying to back down on expenses, if they're worried about their margins, that's a clear story that inflation costs, both on the labor side, probably on the goods side, have really eaten at them. If they're trying to work down their inventory, well, guess what? Inventory was up 1.9% as of the reporting quarter. So I don't see a lot of, I guess I can chart the stock here. If we go to the Wi-Fi Interactive, this is a stock that has been down quite a bit.
Yeah, I took a look at the chart this morning. It wasn't good.
Yeah, exactly. Well, year to date, it's down 16 2/3%. But let's take a look at the 5-year chart so we can see what happened with GameStop. And we had these huge spikes here. We all remember what happened there. But it's been a really slow, steady slog down. And 85 cents, guess what? That is a penny stock.
Yeah.
Penny stock, Brad.
We heard even more about their expressway forward strategy around product, brand, customer execution. That execution is going to need to come fast for sure. As we're taking a look at the opening bell on Wall Street, there you've got a live shot of the New York Stock Exchange and the opening bell on this Friday. As we're taking a look at Model N ringing the opening bell at the NYSE, this market check is brought to you and sponsored by Tasty Trade. Taking a look at the major averages here out of the gate this morning, we've got the Nasdaq, the Dow, and the S&P 500 that we've been keeping close tabs on in the futures market just to see exactly where things open up, and taking a look at them now as we get trading underway on the day. We are down across the board. The Dow is lower by about 0.5%. S&P 500, that's down by about 0.4%. And the Nasdaq is lower by 0.3% right now. For more on today's tape and at least the early activity that we're seeing thus far, Jared, what are you seeing on the Interactive?
As you can see, it's a sea of red, but not any outsized losses. Dow down about 0.4%, 124 points. Still looking positive on the week, but only by about 1/3%. You can see we peaked about midweek, around hump day, appropriately named. That looks like what it is on the chart there. Nasdaq probably looking at some better gains here, about 1%, a little bit more volatility, especially with Fed Day. We saw that big decline after Jerome Powell spoke, and then we saw that uplift the next day. So it's been a seesaw week here for equities. And let's take a look at what's going on inside the market. And here we have the S&P 500 sectors. Staples is the leading sector. Communication services barely in the green, so is utilities. Energy taking it to the downside, so are financials. We're going to talk about the banking sector in just a minute. But crude oil, by the way, not having the best week. We're also going to take a look at that with Ines Ferre later on in the show. And here are some of our leading indicators here, just mostly red. Looks like Korean stocks down 2%, regional banks down 2%, Bitcoin also down 2%. MJ, that's a cannabis ETF, that's in the green. IPOs. not getting too excited about that. And if we take a look at the Nasdaq 100, lots of red today, but let's take a look at the 5-day results. I was just showing you some outsized results for the mega caps over the last 9 days. That goes back to last week. But here for this week, we're seeing some decent gains. And Brad, I know you wanted to talk about Microsoft here. So that is down 0.8% this week, 17 basis points this week.
Yeah, just lingering on Microsoft for a hot second. Of course, there's a few pieces of news around them. I saw trending on Twitter earlier today, ChatGPT and OpenAI,
yes.
And they had published some updates of their ChatGPT plugins there. So that one element, of course, Microsoft, an investor, a major investor in ChatGPT and OpenAI for that initiative to really include some of that generative AI product within their own cloud services. But then on the other side of this too, you've got the Microsoft and Activision Blizzard tie-up that we're still waiting for even more news around. We got some more news on that this morning. UK's competition regulator saying that they've narrowed the scope of the investigation into this takeover of Activision, and perhaps that competition won't be as hindered as once feared here. So taking a look at Activision Blizzard shares here, you've got that up on the screen too.
That's right, and you can see the premium, the takeover premium has adjusted over time, and it is right back to the upper range. I don't happen to know the takeover price, the original one that was floated, but it looks like it's right up against and at least accelerating toward the upper end of the range here. So if the UK is easing up on its objections over the Microsoft deal to combine with ATVI, maybe the US regulators will approach the same way. And that's all about their use, their infiltration of the video console game market. So that's Dan Howley's beat right there. So I'm not going to get too far into it.
Sometimes a beef too, yeah.
Sometimes
$69 billion beef deal. Yeah.
Sometimes a $69 billion deal, beef.
Yeah, absolutely. Let's also take a look at the banks here. As fears over the health of the banking system, they revive amid rising concerns of Deutsche Bank defaulting on its debt. We've got to look at some of the regionals as well as Deutsche Bank here. Let's start there, perhaps, Jared.
Yes, so this is just a 3-month chart of Deutsche Bank, and what really stuck out to me yesterday was this big red candle, because that indicates that happened during U.S. hours. Now, Deutsche Bank is a European bank. Most of the trading occurs between, I would say, the hours of 2:30 and before the equity market in the U.S. opens. Now, Europe closes at about 11:30 for most of their exchanges, so there is 2 hours of overlap here. But when you see the majority of movement of a European stock taking place in American time, that tells you something is strange, and that's what's going on here. Now, historically, that doesn't happen a lot. You'll see those one-offs, but if you go back to the global financial crisis, and I guess we're going to go there, or at least I'm going to go there right now, we had a string. We had all kinds of signals there where Deutsche Bank was just moving on the U.S. market by huge amounts. And so that kind of, for me, is at least an indicator that things are potentially boiling up here. One instance doesn't make a trend, but I'm going to be on the lookout for more instances of that, Brad.
Absolutely. Also, this morning, we'll watch the shares of Micron after the stock closed at its highest point in over a month. This move comes as investors look ahead to its second quarter earnings release. That's set to come next week. Shares this morning, though, they are down by about 0.6%. So this has been a big mover, as well as some of these semi names over the course of the week. I was even tracking NVIDIA earlier on this week, and even that we've got pulled up on our Wi-Fi Interactive past 5 days. NVIDIA holding on to gains of about 5%. And then even over that past 5 days, as we've been kind of taking a look at the broader sector, just tracking the SOX, the Philex semiconductor sector, that's been up by about 2% over the past 5 days. You've got the heat map here pulled up for the semis.
Yes, and we were just talking about things getting better in the U.S. potentially, and the chip sector is highly levered to the U.S. business cycle. Here you can see NVIDIA up 5%. Guess what? It's up year to date. It is up 84%. It is a leader among this group, and let me just switch the time period to show you there. There we go. NVIDIA up 84%. I'm going to sort by performance. AMD 53%. Global Foundries 28%. This is a very cyclical group, and so it's good to see these particular stocks leading the way here. How much room is there to go? As I was pointing out earlier, the Nasdaq itself up against some potential resistance in that historical trading range. I don't know, how much farther can these stocks go in the interim if they're a little bit overbought now? Hard to say, but over the longer term trajectory, these are going to be the leaders if and when things turn around.
Yeah, it's a considerable move, and I know we keep focusing on NVIDIA, and NVIDIA did have a huge conference, of course, that took place this week, which really re-accelerates so much for the industry of the conversation around what AI could mean for cloud. DGX Cloud, we heard about that initially on the artificial intelligence front on NVIDIA's earnings call this most recent quarter. And so now for the rest of the industry that's trying to wrap their heads or their own growth ambition around how they can integrate artificial intelligence into each of their either cloud offerings or suites, data center suites as well, I think that's where investors might be getting a little bit more optimistic and hopefully not kind of ahead of the skis, but at least staying ahead of what the trade might be, just anticipating where this is going to get rolled out to some of those customers, client bases, and portfolio of clients that they have.
We just got to get rid of these bad banking headlines and people can focus rightfully on AI and ChatGPT all over again.
Well, AI would naturally say that you should just be talking about me anyway, right?
Exactly.
Yeah.
Okay.
Also coming up, everyone, TikTok CEO faced a grilling from lawmakers on Capitol Hill yesterday. So what's next? Yahoo Finance's Alexis Keenan has the details next.
TikTok CEO Shou Chew testified in front of the House Energy and Commerce Committee in Washington. He vigorously defended charges from lawmakers who claim that TikTok is a Chinese tool to spy on Americans and spread misinformation.
We have heard important concerns about the potential for unwanted foreign access to U.S. data and potential manipulation of the TikTok U.S. ecosystem. The bottom line is this: American data stored on American soil by an American company, overseen by American personnel.
It was Chew's first time testifying on the Hill, and in a high-stakes showdown, he was grilled in a hearing that lasted over 5 hours.
Have any moderation tools been used to remove content on TikTok associated with the Uyghur genocide? Yes or no?
We do not remove that kind of content.
What about the massacre in Tiananmen Square? Yes or no?
That kind of content is available on our platform. You can go and search it.
I will remind you that making false or misleading statements to Congress is a federal crime.
The vast majority of our users come to our platform for entertaining, safe content. But there are people who do spout some dangerous misinformation, and we need to take that very seriously, invest in it, proactively identify it, and remove it from our platform.
You gave me only generalized statements that you're investing, that you're concerned, that you're doing more. That's not enough for me. That's not enough for the parents of America.
Why did an internal memo from TikTok corporate headquarters explicitly coach senior management to, quote, downplay the parent company ByteDance?
Congresswoman, I have not seen this memo.
You can't answer that question.
You spoke in your opening statement about a firewall relative to the data. But the Chinese government has that data. How can you promise that that will move into the United States of America and be protected here?
Congresswoman, I have seen no evidence that the Chinese government has access to that data. They have never asked us. We have not provided.
Well, you know what?
I
find that actually preposterous.
You know about the blackout challenge. You know about the NyQuil chicken challenge, the Benadryl challenge. Why is it that you allow this to go on? We've already heard, God bless you, from parents who are here with us, who have lost children.
This is a real industry challenge, and we're working
No,
very
it's not
hard.
industry. This is TikTok.
Shou Chew didn't convince lawmakers on either side of the aisle that TikTok is not a threat to U.S. national security or that content moderation is being taken seriously enough. Now, Chew came up here with the mission of turning down the heat on TikTok, but instead that mission seems to have failed. The calls to rein in the app or ban it altogether are now only intensifying.
Meta and Snap, they are up slightly this morning after surging yesterday during the TikTok CEO's heated hearing with lawmakers on Capitol Hill. Both Snapchat and Instagram could be big winners if TikTok is banned. Joining us now with a look at what's next for TikTok and what steps could possibly come after this hearing that took place yesterday. We've got our own Alexis Keenan. Alexis, you were watching this just as all of us were. What were the massive takeaways that we were able to kind of extrapolate from this hearing?
I think the number one takeaway is this absolute unanimous bipartisan dissent against TikTok, with expressing Americans' fears, the constituents' fears of these lawmakers, that the app poses a both physical and mental hazard to youth and also a national security threat. Now, we're not yet at the stage of an actual ban under the Biden administration, at least. So far, the idea of a ban has really been used as more of a threat to force TikTok's hand to satisfy the U.S. lawmakers and Americans that the collection of their data on this app is not being used as a national security threat, given that the company's Chinese owner ByteDance is subject to Chinese law, and that's something that the lawmakers talked quite a bit about. So I want to just play one Q&A between Representative Jay Obernolte of California, Republican. He was a former computer engineer, a video game developer. Here's what he had to say to TikTok CEO Shou Chew.
I appreciate the effort. My concern, Mr. Chu, is I don't believe it is technically possible to accomplish what TikTok says it will accomplish through Project Texas. I just think that there are too many back doors through that process to allow that to be possible, and I think a malicious actor would succeed in inserting malicious code in there if they wanted to.
So then where do we go from here, right? We got all of these statements or non-statements or a lot of evasiveness by Shou Chew yesterday to questions that were posed to him. But from here, I think in order to figure out what happens to TikTok, we need to look at the various U.S. efforts so far that have already been made under two administrations to try to protect Americans' data. So first, you have to go back to the Trump administration and look at the executive order that Trump tried to pass and enforce to force TikTok to divest the company to a U.S. entity. Of course, that was struck down a couple of times by U.S. courts, in part because it had a conflict with the First Amendment, and this executive order seemed to fly in the face of free speech rights. Second, though, comes then negotiations for data protections with the U.S. government, and that is what was referred to so many times in this hearing called Project Texas. All that is really TikTok's name for its initiative to try to appease the U.S. government, right? They have been in negotiations with the U.S. government for 2+ years to try to pass some measures that will satisfy the government. And finally, there are some new proposed U.S. laws that are already been entered into in both the House and the Senate. And one of those is called the Restrict Act. And what that does is it grants the Commerce Department some of the powers that the Trump administration was trying to get through with its executive order. And that would actually allow a ban of foreign apps and foreign technology that poses a national security threat. Now, that's the avenue that TikTok doesn't want, right? So you have to wonder if at this point, after the testimony from Chew that has been described by many as devastating, analysts, media, lawmakers, saying that this was just not a good showing for the company, particularly because of a lot of the questions that were not answered. You have to wonder if they would like to go back and look at that divestiture option, that was maybe a good option to begin with. But certainly analysts are saying coming out of this that it's looking more and more like divestiture might be an avenue here.
Well, and the Chinese government has been very much opposed to that. They would need to approve any kind of, whether it's an IPO or a sale, anything that retains the TikTok data and the user experience. So I understand why they would be hesitant, or why they would be opposed to losing that. Do you really think that the table has turned enough so that that option, the Chinese government seriously could put that back on the table?
Yeah, and in fact, one of the problems that Chew had going into this testimony is right before he started giving it, the Chinese government had issued a statement saying that they would, in fact, have to approve any divestiture, any sale of this company. That really undermined his message that he, I think, was hoping to give to the members of Congress. So it's definitely in flux right now, but the stakes have gone up exponentially for TikTok, and that its hand is really forced at this point because now there is so much momentum by lawmakers and by Americans to want to do something about this. Maybe this time around, right? Maybe taking a lesson from, look, the tech CEOs of American companies, they were put to a grilling before Congress multiple times. They've not been exempted from these criticisms either. So maybe taking a page out of like the lessons that were learned from the past and trying to apply them now in the present.
Chu kept his calm yesterday. I will say that under very, very intense pressure. Alexis Keenan, thank you for that. Coming up, block shares. They continue to trend downward following yesterday's short seller report. But our next guest says while some of the arguments were valid, others may hold less water. And we're going to speak with Mizuho's Dan Dolev up next. Block continues its downward trend today after being on the receiving end of the latest report from short seller Hindenburg Research. The Cash App called the report factually inaccurate and misleading. That's a quote. It says it's considering legal action against Hindenburg. Mizuho senior financial technology analyst Dan Dolev joins us now. Dan, thank you for being here. Could you just outline some of the arguments from the Hindenburg report and a lot of these concerns known by the analyst community? Some valid points, as you have admitted in your latest note. But what are some of the details here?
Hey, thanks for having me on the show. Always a pleasure. Look, I think the main argument that Hindenburg is making is that of the 50-something million monthly average users, a big proportion of them are, engaged in, sex scandals, drug deals, et cetera, et cetera. And that puts a stain on pretty much all the Cash App users, which I would say the majority of them are ordinary people. So I think that's like the one allegation that they're making that's getting people very, very scared is that this is used for illicit activity. Of course, there's always use for illicit activity for anything that has to do with money, but it doesn't mean that the majority of the Cash App users are actually doing that. And I think that's kind of the false or the premature allegation that Hindenburg was making. And that's what's getting people really, really agitated, that comment by them.
And Dan, I mean, even within all of the allegations that have come forward, and of course the response that we've heard from Block and whatever is next to come within that campaign, you still have a buy on the stock. $93 is the target. Is there anything within this report that would change that for you?
I think that if you go back to our research, and that's an excellent question, we downgraded Square or Block a few months ago, and that was based on the Cash App. What made us change our mind is actually the profitability, or the ability to achieve more than $1.3 billion of profit, EBITDA profits this year. We think they could do as much as 1.7 or 1.8. And then next year and the years after, they could go back to, 2 billion, 2.5, 3 billion of EBITDA. And they're now focused, by the way, on excluding stock-based comp from their math, right? So basically it's a very legit number. That was the impetus for our upgrade. So that does not change. Are there concerns about the Cash App? We had those concerns. Most of them are actually, I would say the Cash App is actually growing, and most of our concerns are well known by the investment community. So there's really nothing new other than the fact that if, we found out that most of these 50 million miles are actually used for drugs, which I find very, very hard to believe. That would be the only thing that would be a problem. I think it's very unlikely that that's the case.
And I'm just thinking about some of the competitors here. You have Venmo, you have the Zelle app that's shared among some of the bigger banks. Are there allegations that persist in the industry against some of these other apps that are similar to that which being leveled against the Cash App? I would think if you're engaged in some of these activities, you have a host of options here. And just wondering if they're leveling the accusations evenly.
Yeah, they're not. And I think you're spot on with this one, right? So again, I think they've singled out the Cash App, and there's a lot of I think undertones in that Hindenburg report, which I didn't like, and I thought were inappropriate as well. In terms of like the certain demographic or certain income level of people that use that. I'm sure that because millions of people use Venmo and millions of people use Zelle as well. I'm sure there's things going on in every P2P or payments app, but the report chose to go after Square, after the Cash App, which I think was inappropriate. I'm sure to a certain extent these things happen everywhere, and I don't know to which extent, but I'm sure. Actually, I want to make one interesting comment. They said yesterday in the report that of the accounts, the compliance department of Square or Block, of the accounts that they said were fraudulent, like 47 or something % were actually found to be fraudulent. I think it's not. It actually means the compliance department is doing a great job. They're finding the accounts that they think are fraudulent, and they have a pretty good hit rate. So I don't understand why people are so agitated. They're doing I would have expected to see a statistic that says of the accounts that we said were fraudulent, 100% were actually fraudulent. That would be amazing. So they should even do better in terms of singling out those accounts. So I don't think this is actually a valid argument. I actually don't think it holds much water. And last thing I want to say is gross profit is 100% kosher. They're not accused of fudging numbers or anything like that. So the numbers speak for themselves. The Cash App gross profit accelerated quarter over quarter. And that's the most important thing to keep in mind. The numbers themselves are kosher. The MAUs are honestly not as big of a metric we use on, in the investment communities as this report made them look like. It's not something we talk about. We talk about gross profit, not the MAUs.
So it also comes back to the amount of real people then that you're banking, or at least kind of formulating your expectations for how much they're earning per average user, as they put forward, but per individual person is what this research is kind of calling out, that the numbers aren't actually representative of individual people, but instead could be representative simply of an email address or a unique identifier instead. Does that change the calculus of how to even cover or how to even evaluate the financials here?
It does, but let's make believe that there's fewer real people, right? Mm-hmm. All that means is that the real people are doing more per person. So it's just actually it's almost like a good thing, right? So the engagement of the real people. So you're dividing your denominator. If your denominator is smaller, then the revenue per person is bigger. So the average, all it means is that the average Cash App user, legit Cash App user, that's not a fake account, hypothetically, is actually doing more with the Cash App. I think that's a good thing, not a bad thing. So we're talking here about just like, math and perception more than actual numbers. That's why I said before, the gross profit, right, is kosher. The number itself is kosher. It's the real number. They're not inventing the number. And so that's why I think a lot of these things were a little, I think a lot of the accusations there were a little bit wishy-washy. And they also put a stain on a big part of the population, which I think was inappropriate.
Just lastly, while we have you here, there seems to be more of a crypto crackdown among regulators that is starting to formulate even more. You've been strongly worried about Bitcoin in the past, but as it relates to a company that we're discussing right now in Block and the subsidiary Cash App, where do they need to perhaps change or get ahead of regulation that may be coming forward in crypto?
I personally, I'm a huge crypto bear. I mean, it's very open. I know we have an underperform on Coinbase for that reason. And their downgrade on Square, which we did last year, was, we said that management is over enthused or over focused on Bitcoin. I think the right thing to do, honestly, personally, would be the Bitcoin revenue on the Cash App is a very small part of the overall Cash App. It's single-digit % in terms of the revenue it generates. I think they need to disassociate Bitcoin from the Cash App. It would make it more legit because we all know what Bitcoin is used for. The use cases for Bitcoin are exactly the use cases that people are worried about. And so disassociating the value that Cash App provides from Bitcoin, I think would do good for Cash App, not bad for Cash App. So I think that's maybe the one change that would be good for the company.
Interesting. Mizuho Senior Financial Technology Analyst Dan Dolev. Dan, always a pleasure to speak with you. Thanks.
My pleasure.
Guys, coming up, Ford is hitting the accelerator on its EV push. We're going to share Brian Sozzi's interview with Ford CEO Jim Farley. We've got that for you in the next hour. You do not want to miss it. Let's check in on one of today's trending tickers. We're watching shares of Coinbase, the stock extending declines after the company disclosed this week that it received a so-called Wells notice received from the SEC describing its plans to take legal action against the company. Shares are actually flat right now, just barely to the downside, but over the past 5 days, you see the significant decline. It's lower by a little more than 11%. On the dip, ARK's Cathie Wood purchased more than $17 million worth of shares via ARK Innovation and ARK Next Generation Internet Exchange Traded Funds. Well, coming up, what's next for the Fed? Citi's Nathan Sheets is going to give us his base case scenario. We've got that on the other side. Welcome back to Yahoo Finance. I'm Brad Smith alongside Jared Blickery. Let's take a look at the latest market action and what's been a bumpy week for markets following the Fed's latest rate hike decision and further pressure in the banking sector. 3 major averages here. We've got them pulled up for you. We'll just recalibrate and reload that. But as of right now, you've got the Dow Jones Industrial Average up on your screen right now. Here over the past 5 days, over the course of the week, still in positive territory. It's up by about 0.25%, but down by about 0.5% here on this Friday session. The Nasdaq Composite, you're seeing that lower by about 0.5% as well right now. Over the past 5 days, still holding on to gains though of about 0.9%. S&P 500, you're seeing that lower here today by about 0.5%. So mirroring what we're seeing on the Dow and the Nasdaq, roughly on a percentage basis, but still over the past 5 days, net higher by about 0.3% here. Also want to take a quick look at some of the sector activity as we're just about 35 minutes into the trading session on this Friday. We're mixed, but we've got more laggards than advancers investors. Utility is leading the pack right now. That's up by about 0.9% here. And just giving you some broader context on how that's been doing over the course of the year, it is still lower over the course of the year by about 8.8% there. But also the sector that's seen the most turmoil as of recent, and much of those declines coming over the past couple of weeks here. Down now 10% year to date is the XLF, the financial sector here in the S&P 500. And I want to take a look at some of the banks here just very briefly, as that is the biggest laggard on the day for XLF. You've got some significant moves even in the major banks, as it's banks helping other banks. JPM, of course, continuing to try and work with First Republic Bank. That is going to be on our regional bank screen here, in First Republic Bank for its own right. As I'm trying to find them, let me put this on an equal just so we can locate them very briefly here. Well, they are lower on the day, it seems, as well right now. There we've got that pulled up. Whoever hit that, thank you. Appreciate it. Also, them down by about 89% over the course of this year, but those declines coming amid the turmoil. Now, with all of this considered, the Fed continues on its rate hike trajectory despite recent banking stress. And while U.S. officials continue to tackle inflation, the downside risks around the Fed's forecast becomes potentially more acute. So here to discuss is Nathan Sheets, Citi Chief Global Economist here. And Nathan, over the past couple of weeks, especially this week, considering some of the either fire sale buyouts and acquisitions that have had to take place, or even the cash injections that have needed to be put forth, where do you see this all netting out? And is this a crisis, as some have called it, or is this just something that is typical of the banks given a volatile environment like this?
I think the only good news I have is this is not 2008. The banks are better capitalized. The regulation is better. I think risk throughout the system is valued more appropriately. But this is a pretty tough episode that we're going through. Yeah, at a minimum, we could call it banking sector, financial sector stresses, whether, as you ask, whether it rises to the full term yet being a crisis, I think is an open issue. But this is a tough time. And there are some meaningful stresses in the banking system as banks' balance sheets adjust to the realities of, this is a higher rate environment. And as the Fed continues to hike rates and the ECB continues to hike rates to fight inflation, this is a tough episode for markets, for policymakers, and for the economy.
And it is, and I'm looking at your projections for the Fed's terminal rate, and you expect another 3/4 point rate hikes, taking the range from 5.5% to 5.75%. That I would say is above the consensus here, a little bit hot. But how do you square that too with the rate cuts that have been aggressively priced in coming quarters? I remember a year ago, people were pricing in rate cuts as soon as right now. Obviously, that's not happening. We're still raising. So just wondering how those two dynamics are playing out. You're thinking the Fed is going to raise rates another 3/4 points, and then what do you think about those rate cuts that are priced in?
Well, our baseline expectation is that these financial stresses largely abate over the next 6 to 8 weeks. It's going to be bumpy. It's going to be uneven. There could be some more pressures and challenges along the way, but that they largely dissipate. And as that happens, the Fed is still left with the reality of a tight labor market and rising services inflation. And that is going to require more Fed rate hikes, and ultimately they'll need to take the Fed funds rate into the mid 5% range. But that's our baseline, but we're sweating bullets around it, to say the least. It would probably put a 2/3 probability on the baseline. There's a third of the probability mass on weaker outcomes, which would involve rate cuts of various stripes and varieties. But kind of bottom line, if things go as we expect, it's going to be mainly about inflation. We are worried, deeply, profoundly worried about downside risks that would require more aggressive policy from the Fed, not only liquidity front, but also on a rate cuts front as well.
Look, Nathan, you're not lying. I think all of us need stronger antiperspirant after what we've been watching within the banking sector over the past couple weeks here, because we're sweating hard. At the end of the day, I think I'm going to need to answer to my mother, my family, about what's taking place right now. And even within the base case scenario that you've laid out, and I can go back and play a clip for them. What do I tell them? What do you tell the average person who is looking at this right now, or the investor that's trying to position their portfolio to say, don't be concerned unless you see this? What is that you would be looking at?
I think that if we see a further proliferation of banking sector stresses, either into the smaller banks or into the larger banks, I think that would be, for me, really a indication that there is a deeper risk here in the United States. So far, the stresses have been concentrated in the medium-sized banks with assets of roughly $100 to $250 billion. And that is a group of banks where Congress and the Fed in 2018 made a decision to reduce the vigor of regulation. And that is where the problems are arising. But if we start to see a further proliferation into banks of other sizes, larger or smaller, I think that would mean that we need to kind of revise our narrative on what's happening. More fundamentally, I think the issue here is that banks are adjusting to the reality of higher rates. And that's true in terms of the implications for the asset side. It's true implications for deposits and what they need to pay on the liability side. And also it's true for bank margins, which are currently under pressure, is they have to pay more on deposits.
Well, that was my next question there, because there's a huge mismatch between what banks are paying on the deposit side and what investors can get on the money market side. And I have a chart here on the Wi-Fi Interactive. This is the assets in money market funds, and this goes back to mid-2020. But the acceleration that we're looking at here started when the Fed started really aggressively increasing its rates. What's taking banks so long to adjust to this reality? If banks want to stem this outflow, they have to reduce their profitability. Is there some other hat trick that the Fed or regulators can pull that would somehow stem the tide here?
The Fed has created facilities that give the banks plenty of liquidity to be able to meet any conceivable outflow. And we are seeing banks borrow at the Fed's discount window and at various other facilities that the Fed has created so that they can meet that outflow. But I think ultimately it's about the stickiness of deposits. The many, particularly retail deposits, are unlikely to move to money market mutual funds. And operational deposits may not move because it's challenging, and you rely on your bank for transaction services. But the extent of the outflow and the reality that you can make more in a money market mutual fund is a challenge that the banks have to respond to, and it is going to continue to require them to increase what they're paying on deposits. And how much they'll need to raise that deposit rate, I think is an open issue, but it has huge implications for their profitability going forward. And I think that over the medium term, just how damaged the bank's business models are, just how challenged or maybe even underwater the margins are for a while is the key question that people are thinking about in terms of the sustainability of some of these financial institutions.
In mobile banking, people just press that button. They got their passwords set now. They can move that money in an instant. So we'll see if that stickiness remains here. Thank you, Citi Chief Global Economist Nathan Sheets. Coming up, why turmoil in the banking sector could have a negative impact on commercial real estate. Yahoo Finance's Danny Romero has the details. Up next.
Welcome back. You're watching Yahoo Finance, and here is a quick check of the markets sponsored by Tasty Trade. Dow Jones Industrial Average, that is down right now by about 0.6%, 200 points in the red. The S&P 500 and the Nasdaq also in negative territory. The S&P by about 0.6% as well, and the Nasdaq by roughly the same on a percentage basis. Looks like as of right now, only two sectors in positive territory at this point in the day: utilities and consumer staples. 9 out of 11 S&P 500 sectors in negative territory. The commercial real estate sector has taken a beating in recent years. Now the banking crisis is likely to strike a few more blows. The pandemic left office buildings barren, and rising rates, they took a toll on the cost of commercial mortgages, which would likely be tough to refinance at current rates. Now a pullback in lending among small banks in the wake of Silicon Valley Bank's collapse could exacerbate some of those troubles. Yahoo Finance's Danny Romero has the latest. Hey, Danny.
Hey, Brad. So if there's anything commercial real estate doesn't need right now, it is a banking crisis. These building owners have been hit hard by higher interest rates, which cause them to have higher borrowing costs for them and those property values to fall. Now they're faced with stricter lending rules. Loan officers have reported that they have experienced tighter lending standards in January for non-residential and multifamily properties. And they say that it's given to the recessionary fears. But to put it into perspective, 80%, more than 80% of commercial real estate loans are held by banks with fewer than $250 billion in assets. That's what Goldman Sachs says. And now there's new pressure on the regional bank side, given the recent news for Deutsche Bank about their debt obligations. But how did we get here? Smaller banks have actually been increasing their exposure to commercial real estate after the great financial crisis in 2008, which was triggered by a housing bust. And they stuck with it even after the pandemic. And now with the Fed raising interest rates, what does that mean for the industry? Well, Fed Chairman Jay Powell said in his press conference this week that he anticipates tighter credit conditions from banks as there is this pullback. He also said that the banks that have the high exposure to commercial real estate loans will not end up being like a Silicon Valley Bank issue. He said, he said, the banking system is strong, it is sound, it is resilient, and it is well capitalized. So he's even optimistic, per se.
All right, so what's the next shoe to drop here for commercial real estate? We know the timelines, they take a lot longer to play out than, for instance, residential real estate because the leases are 10 years, but there are problems surfacing. Just wondering what you're talking to some of your contacts about.
Yeah, another area of concern is office space. And we've already seen that here in New York City, that people are not flocking back to the office. They like that hybrid remote scenario. But data from TREP actually shows that top office tenants that have a lot of exposure to that area include Western Alliance and First Republic Bank, with loans ranging from $170 to $570 million in size. So if we see property buildings default, that means that less valuable assets on a bank's balance sheet. So that would be not really a good picture. But again, like you said, it takes time for all of that to evolve.
Yep, you got to get those write-downs. Sometimes those take quarters to evolve. So we'll see what comes of that. Thank you for that, Danny Romero. Household routines and the use of living space in homes changed drastically after the COVID-19 pandemic as people began to spend less time outside. Home improvement and repair spending soared to an estimated $567 billion last year, according to a report from Harvard's Joint Center for Housing Studies. Despite this impressive investment, the research suggests, well, guess what? American homes will need further changes to prepare for disasters, improve energy efficiency, and meet the needs of an aging population. So here to discuss is Harvard University's Remodeling Futures Program Director, Carlos Martin. And Carlos, thank you for joining us today. Just break down here what you're working on for us, please.
Sure, thank you. I mean, you hit the headline right now with regard to the levels of spending that occurred, particularly during the pandemic, that passed in real terms the past boom in the mid-2000s. I think what's most interesting out of this is really that not only did individuals spend more per project, and some of that was due to inflation, but also that the range of people, of homeowners that were doing improvements increased. It wasn't just the higher end, upper end market doing bath and kitchen remodels. It was a wide range of projects, particularly among middle income owners.
And so this at a time where we're still waiting for much more capacity to come online, especially in some urban cities, urban areas where that can start to drive down the rent costs that have absolutely skyrocketed, as there has been this intersection between people who were potential home buyers that then moved out of that market and back into the rental market, at least temporarily, until prices started to ease and become a better environment to then start kicking the tires, or at least submitting some offers even on a potential home as well. And so where are you seeing some improvement there, perhaps?
So we're certainly seeing improvement in terms of some of the smaller scale projects that homeowners can take on. And let me be clear, we saw drastic growth in rental improvements as much as homeowner improvements. So it's across the board, there was a wide set of growth there. And part of the reality is that our homes are aging. And so because they're aging, there's going to be a need to do replacements. Those things are going to cost money. But in some of these cases, like doing an energy efficient improvement, you'll be saving money in the long term. So there are also additional benefits that would come from things like that.
And what's the scale of some of the improvements that people are making here? We've seen, I remember from early in the pandemic, people got rather aggressive about them just because of the amount of time on their hands, but just wondering how that's shifted over time and what the priorities are right now.
Certainly, the range of projects goes from typical HVAC, floor, so the replacement. And so let me help define what the market is. So repairs and maintenance are things just to keep your current projects going forward. There's no real, assume no real added value to your house. Improvements is the biggest share of the market. That's about 2/3 of the market. And that's for rentals and for homeowners. And then among those improvements, we saw replacements. So this is replacements of whole systems, including things like HVAC, including your roofs. So people invested when they were staying at home during the pandemic. They couldn't take trips. They decided anecdotally to invest that money in their own homes. And so a lot of that money, a lot of that high headline market growth was from those kinds of replacements.
Oh, I know I invested. Well, it wasn't a home. It was just an apartment. It's New York for you. Harvard University's Joint Center for Housing Studies Remodeling Futures Program Director, Carlos Martin. Thanks for joining us this morning. We appreciate it, Carlos.
Thank you for inviting me.
Absolutely. Coming up, more turmoil in the crypto sector after Terraform Labs co-founder Do Kwon was indicted on fraud charges. Yahoo Finance's David Hollerith has the latest on this next. The crypto collapse escalates as Terraform Labs co-founder Do Kwon was charged by the U.S. prosecutors with fraud following his arrest in Montenegro. What does this mean for the state of crypto? Yahoo Finance's David Hollerith has the details. David, what do we know so far?
Brad, so Kwon was arrested trying to board a flight in a Montenegrin airport using falsified documents yesterday. And shortly after his arrest and subsequent identification by Interpol, the International Police Organization, the U.S. Justice Department unsealed an indictment charging Kwon with an alleged 8 counts of fraud. Now, the United States Office of the Attorney in the Southern District of New York tells us it's seeking Kwon's extradition for him to face charges in the U.S. His native country, South Korea, is also seeking extradition. While it's not abundantly clear here yet where Kwon will face charges, his journey from star crypto entrepreneur during the 2021 bull market to now has been a tragedy. Once his company was well known for having created this blockchain ecosystem known as Terra. And there are 2 coins that were important here, that Luna and Terra. One was a stable coin, the other one was a connected cryptocurrency to it. And together, they plummeted in the beginning of May of last year, wiping out a combined $40 billion roughly. And since then, in the 11 months since then, no one has been able to locate Kwon per se. And he's not really, this situation, Terra is not blamed for what caused crypto to blow up last year, but it's definitely thought of as the first major event that caused the market to collapse. And Kwon has been under investigation by several government agencies for the past 11 months. In mid-September, he denied he was on the run over Twitter. South Korean court also issued an arrest warrant. And this followed Interpol also issuing a red notice, basically requesting the location and arrest of him internationally to other government agencies. So last month, Korean prosecutors also said they were searching for Kwon in Serbia, and the SEC charged him with defrauding investors. So that's where we are. That's where this has all come.
All right. Appreciate that report, David Hollerith. All right, coming up, charging up and changing out its EV offerings. We're going to share Brian Sozzi's interview with Ford CEO Jim Farley. That is up next. Welcome back. Energy markets dipping on worries about an oversupply, especially after the U.S. signaled it will wait before refilling its strategic petroleum reserve, the SPR. Weakness there contributing to the overall gloom in the markets. Here with more is Yahoo Finance's Ines Ferre. Ines.
Yeah, Jared, and this lower oil prices, it's really having an impact on energy as a whole, energy stocks, equities as well. Let's take a look at our Wi-Fi interactive board so we can see where the underlying commodity crude oil is right now. You're looking at WTI that is down more than 1.5%. You've got crude right now that is on pace for its biggest first quarter drop since 2020. That's when the pandemic hit and you saw demand being wiped out. This week, we had a little bit of a rebound when it came to oil, but today we are seeing losses, taking out a big chunk of the gains that we had seen this week. Also, Brent crude down 1.8%. Remember that last week you had oil that on a weekly basis last week lost almost 10% of its value. A lot of this has to do with a stronger dollar, which is impacting the price of oil because oil is invoiced in dollars. You've got the U.S. now that is holding off on refilling its strategic petroleum reserve, as you just mentioned, Jared. Also, you have Russian oil that is still coming into the market despite the Western sanctions. And then you've got concerns about a U.S. recession and the banking concerns, the banking worries, deepening worries of a recession. You've got institutions that are selling their oil futures. Now, we have been seeing Wall Street sort of pulling back a little bit on their forecast when it comes to crude oil for the end of the year, but not as much as you would think. I mean, one of the commentaries that I saw out there that is that this isn't necessarily like 2008 where oil touched a low of $39 a barrel. Analysts aren't seeing oil going that much lower. But nonetheless, we are seeing a sell-off when it comes to oil recently. And then just taking a look at other commodities. Look, if you're a gold bug, you are happy this week because gold touched $2,000 an ounce. I've spoken to analysts saying this is it for gold, guys. The gold is coming out is breaking out from here. We'll see, but certainly one analyst telling me 2024 that's going to be huge for gold, guys.
All right, Yahoo Finance's own Ines Ferre. Thanks so much for that, Ines. Appreciate it. All right, well, to quote the great Marsha Griffiths, it's electric. That's what Ford would probably say if you were to ask about its future and the vision for it. The automaker banking on new production methods for its latest electric vehicles to address its biggest challenges. Yahoo Finance's Brian Sazi goes under the hood of the automaker with CEO Jim Farley. And here's what he had to say about the challenges of sourcing and building batteries.
First of all, batteries are the constraint here. It won't be the manufacturing site behind me. And the lithium-ion batteries that we use, both lithium and nickel are really the key constraining commodities. We normally get those from all over the world, from South America to Africa to Indonesia and Southeast Asia. We want to localize that here in North America, not just the mining, but the processing the materials. Actually, even if they're mined, let's say in the US, nickel, most of it is sent back to China to get processed. So the big change is going to be to onshore all that capability of processing, but also mining back here in the US. It'll be a huge job, just like it has been for semiconductors.
Can you get the materials you need, batteries, workers, to achieve your electric vehicle goals? And what are some of those goals?
Yeah, we're going to build, we build about 5 million vehicles around the world at Ford. We're going to build an extra 2 million with our EV business. That's why we call Model E a startup, because we're going to grow the company's revenue by 30 or 40%. And we're already number 2 in EV in the US. Most of the customers are new to us. So this is a growth business. We have to get these materials from around the world until we localize the supply chain, which is what we want to do. By the end of this year, we'll secure all the raw materials to make the 2 million batteries by 2026 that we're going to need to go in our vehicles. So we should be in good shape here. A lot of other companies are going to have to hustle to get that, but we're in good shape because we've been working on it for a couple of years now.
We'll talk more about the EV outlook in a second, Jim, but talk to us about the new truck that you teased, the T3. Is this some form of autonomous super truck? What is it and when does it launch?
It launches in about 30 months. So just over 2 years. We haven't shown anyone the truck yet because we don't want to give an advantage to our competition. But it is a built for tough real work vehicle, but it'll have technology no one's ever seen in any of these electric trucks. We're the best-selling electric truck now with the Lightning. This will be a lot better. It'll be fully software updatable, so every part we can ship software to the car over the air. Your trucks are going to get better every time you get in it and move every morning. In fact, we think we're going to be able to land a semi-autonomous system, so you'll be able to go to your sleep in your truck while you're traveling on the highway. And it would be, I think, maybe one of the first vehicles you can do that safely in the U.S. And we think that kind of advantage is a big deal for truck customers. A lot of them work. They use their vehicle as an office, and to be able to do more work, bid out more jobs inside their truck while they're commuting to the work site is fantastic.
Jim, I'm a car guy. You and I have talked about this before. You're a car guy. How are you going to drive in a truck? So the truck is going to drive by itself and you could fall asleep in it.
Yeah, I mean, you're a car guy. On a sunny day on a highway, we have the technology. We're just finalizing it now. We took 600 engineers out of Argo, and they've been working on a autonomous feature that while you're on the highway on a sunny day, which is a lot of miles for Americans, you'll be able to, drive. We have the most successful hands-free system now. We just now need to make it even more reliable so you can take your eyes off the road, not just your hands off the steering wheel. And that technology is right around the corner, and you'll be able to do that in this kind of truck. That's why we're making it completely software enabled. We're doing the whole electrical architecture and all the software we're bringing back in-house at Ford.
We've also talked in the past about your focus on making the automobile subscription oriented. In this truck, will I have to pay for heated seats? What will I have to pay for every single month?
No, we're not going to charge a subscription for heated seats, but for productivity, it actually turns out we kind of know what the first 3 shippable software to the car is. Kind of like when we all first got our smartphones in 09 and 10 with music or email, and it is productivity. So we can now do telematics, predictive failure, driving coaching, even predictive failure of components on the truck. That's one thing, productivity. The second thing is partial autonomy. So that could be, hands off like we offer today, even eyes off in the future. And the third one's going to be safety and security. Like think of your Ring or your Nest at home. We're going to be able to record video. If someone takes something in the back of the bed of the truck, or someone takes your vehicle, we'll be able to have the video content and send alerts when you go over the speed limit, whatever it is. Those are the 3 softwares that we'll be able to ship to this kind of vehicle.
All right, good to know the price of a warm butt is included in this truck. That is always good to hear. I just wanted to get that word out there. Now, Jim, you had a teach-in event. The CFO and your team down at the New York Stock Exchange really went into great detail on new reporting structures for the business. Now, we talked to your CFO, John Lawler.
Yes.
And he broke down the longer-term operating margin for that EV business at 8%. Now, I got a question. Well, Tesla's at double digits. Why is that the case?
Well, Tesla hasn't had any competition until Ford and others came along. Now their prices are down like $7,000 in 1 year. So there's going to be more price competition, in that market. And we're counting on that. When we say 8%, it won't be at the prices we see today. And what we have to do is we have to design the truck differently. We have to scale with a plant like Blue Oval City here in Tennessee. We're going to have a more efficient distribution with no inventory, online, configuration. You can buy the vehicle and configure it online. And then we need to have a different manufacturing process with less labor content in the vehicle. When we do all those things, we'll make an 8% margin. If it was today, we'd make more than 8% because there's not as much pricing competition as I know there will be.
What are you seeing in the market right now for EVs? So all of your EVs have gotten really, really high marks, but you have a Tesla out there now cutting prices. What has been your response? What are you seeing in the marketplace?
Yeah, it's an interesting dynamic. The market is actually changing more than we expected, but that's a good thing. First of all, we have really no competition for Lightning and E-Transit. Both are best van and truck in their segment, electric, and we haven't cut or adjusted prices at all. On the Mach-E, the Mustang Mach-E that competes with the Model Y, you know, our sales continue to go up. We've had to adjust the prices down, but we also have a new affordable battery coming for the Mustang Mach-E, and we're now doubling production, and that's starting to hit our showrooms now. So the demand is really strong for us. It is not the case for everyone, though. A lot of other EVs aren't selling. So I think, like always, it comes down to the best product wins. And I'm sure glad we're playing to our strengths. You know, Mach-E is a Mustang. Transit, Transit's a van, and we do really well. And people love Ford trucks. So we're just playing to our strengths. We think that's the right move.
And Jim, you have an amazing look into the EV industry. Not only are you the CEO of Ford, but you're also on that Harley-Davidson board of directors, a company I know very well, and they have also pivoted to electric vehicles and electrification. How difficult is it to make that pivot to EVs with these legacy companies? Can you bring us inside these boardrooms a bit?
You know, it's a really interesting question. And I would say that the common thread between Harley and Ford, these iconic companies that are changing, first, you got to play to your strengths. You know, if you're going to go into a new market like electric vehicles or motorcycles, you got to play to your strength. You got to go after segments, even if they're new customers, for things that you know really well. Like our, Lightning will power your house for 3 days. It's got a huge trunk. You know, those are things that the challenger brands didn't really know about because they don't know the customers. The other thing is you got to organize differently. You need focus. These are new businesses. You can't use your prejudice of the past. I could give you 1,000 examples, like our wiring harness on the Mach-E. It's 1.6 kilometers longer than it needs to be because we used our internal combustion engine engineering standards for that wiring harness. But in electric, all that math changes with that heavy battery. So you need to set up a separate business with more focus. That's what Livewire is doing. That's what we're doing Model E. And I think that's the only way to reinvent the company like we're doing. You have to approach it as a startup.
That was Ford CEO Jim Farley alongside Yahoo Finance's Brian Sazi. Coming up, shine bright like a diamond. And they're forever. There's so many different lyrics you could lean into, but are they mined or lab grown? That's not a lyric you've heard before. We're going to speak with the CEO of Brilliant Earth. That's next. As inflation rattles consumer spending, there's one industry that could stand to benefit. Lab-grown diamonds accounted for 15.7% of all engagement rings sold in the U.S. in December, nearly doubling its market share from a year earlier, according to Tenoris. For more on the industry, we're joined by Brilliant Earth CEO Beth Gerstein, alongside Yahoo Finance's Brooke DePalma. Beth, great to have you here with us this morning. First and foremost, I mean, we're just taking a look through some of the results here. And in 2022, you gained more share, you had strong profitability. How do you kind of begin to compound on some of that profitability that you've been able to experience?
We're really excited by the results that we had last year. We have really strong brand momentum, an all-time high of searches for Brilliant Earth. We have a fantastic differentiated product and a brand that really means something for the next generation millennial and Gen Z consumer. We also have, I think, a very differentiated omni-channel model. We've been expanding our showroom footprint. We had ended the year with 25 showrooms and expect to launch about 10 or more this year. So a lot of really strong initiatives around jewelry, around showrooms, and around just overall growing our brand awareness.
And emphasizing that pullback on discretionary spending. You guys did have 25% more customers in 2022. So break it down for us. Are consumers turning to perhaps lab-grown diamonds or lower cost options in this sort of environment to perhaps get bigger diamonds for less money?
I think lab-grown diamonds just continue to grow in popularity. We've been selling lab-grown diamonds for over a decade, and so have really been leaders here. I think it really provides a nice assortment for the customer, a nice choice. I think some customers really like that it's mining free, they're affordable, they're beautiful, and they do allow you to get that bigger diamond that you've really had your eye on.
And perhaps in this sort of environment, customers are looking for long-term investments. And so break down for us, what is the difference in resale value of a lab-grown diamond versus a natural diamond?
I think that customers don't really think about this as something they're going to have to sell later. They're buying a diamond for the emotional value. It's a symbol of love and commitment. And so whether it's natural or lab, customers are buying this because of how it makes them feel. And some customers really like in natural that they're buying into something that's romantic. It has, many billion of years of history. And I think lab, gives a different value proposition. So I don't think it's about resale value. I mean, try selling a diamond anywhere after you purchased it. And I think that, certainly I don't think it's going to have the same value as when you originally ended up buying it.
And can you talk to us about the identification process? Is blockchain being used now? We saw the resurgence in the first place of NFTs a couple years ago. I know that has died down, but just wondering, people are more interested. We now have the technology that's capable of tracking not only real diamonds, but lab-grown diamonds as well. What is the user demand for this?
We've been selling blockchain, actually, blockchain-enabled diamonds for many years now, since 2018. And the value that we see is that it allows you to have a lot more confidence in the journey of a diamond. So, ultimately there's a database that's immutable, that continues to be appended by the next chain of custody. And so you have transparency that you just didn't have before. You know exactly what the diamond size was when it was unearthed, what the rough diamond carat weight was. So I think that there's a lot of interest overall from the customer standpoint in terms of the practices, making sure that they're buying something that is consistent with their values, that's sustainable and transparent.
And Brilliant Earth does consider itself a digital-first brand. I want to emphasize that here. But you guys, as you mentioned, did open those showrooms. And so I'm curious, how do appointments then translate to sales? And do people still buy more online or at those showrooms you guys are investing heavily in?
We think the winning model in this space is really about omni-channel. Customers oftentimes start their journeys online, so they'll do a lot of research. This is a new category for them, and this is one of the largest purchases that they're going to make at that point in their life. And then they really like coming into the showroom and being able to touch and feel the product and really working one-on-one with our jewelry specialists. It is a high-touch sale, so making sure that they feel really confident and comfortable in that purchase. and ultimately, walking out with this really beautiful product. And shopping together is another, I think, big trend that we're seeing. A lot of couples come in together, and we're able to provide a personalized and curated experience. So we know exactly what they want based on what their digital shopping behaviors are, and then we're able to curate that appointment. So that's what's so unique about our model is, we have so much more information about the customer that makes that customer experience so much better, and ultimately it's going to drive conversion. So when we open a new showroom, we see these amazing economics in terms of lifting the overall metro market. It lifts it over 100%. So it's really great for the customer experience, and it's also great in terms of the bottom line.
Absolutely. We only have about 30 seconds left here. I'm just wondering, in terms of that experience and taking the digital experience and what you've been able to power there into those showrooms as well, and having that same type of profitability and that margin at the end of the day, how do you maintain that even as you do power that new type of experience where a customer is coming in to a brick and mortar capacity?
Well, I think it's just having really a disciplined approach to how you're managing your investment. So every time we're opening a new showroom, we have strict ROI thresholds, and it's about a mix of that customer experience, but also making sure that you're being financially responsible. And that's how we've been able to drive profitability. We exceeded our expectations in Q4, and we're going to continue to have a really keen eye there in terms of providing a premium experience, but also making sure we're driving profitable growth.
All right, Beth Gerstein, who is the Brilliant Earth CEO, alongside Yahoo Finance's Brooke De Palma. Thank you so much for taking the time here with us, both Beth and Brooke. Appreciate it.
Thank you so much.
Absolutely. Well, Shou Chew gave testimony on TikTok's impact on users as well as the platform's data security features yesterday. And for more on the outlook for a U.S. TikTok ban as well as the app's privacy features, you can stay tuned to Yahoo Finance Live. We've got an amazing guest lineup to give you the latest TikTok coverage.
Plus, the owner of Ryan Reynolds' creative agency will join the show in the 11 o'clock hour to weigh in on the platform's privacy features.
And later today, Federal Communications Commissioner Brendan Carr will join Shauna Smith and Dave Briggs on their 3 to 5 show. You do not want to miss it. We've got all that and more. Yahoo Finance's Rochelle Acupo has you for the next hour of trading from Brad Smith and Jared Blickery. Well, just stay tuned for the next MBA.
We know it.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this hour. Falling dominoes, bank stocks send the market lower as fears over financial stability resurface. JP Morgan, Goldman and Bank of America all in the red. Germany's Deutsche Bank was the catalyst. Its shares falling as the cost to insure against default rockets. And market sentiment dropping and Citigroup adding to the doom and gloom as it reaffirms its underweight call on US equities. We'll take a closer look at the retail investor and what assets are in vogue at this tricky time. And the aftermath. TikTok CEO got the grilling of a lifetime in Congress yesterday. But what are the likely next moves in this story? We'll speak with one expert on whether or not our attention is focused on the right issues. But first, let's take a look at how the major indices are faring. All three in negative territory, although we are seeing some of that selling action starting to slow, but still, the Dow there off about 200 points on the day, 0.6%. The S&P there also down about 0.5%. That's being dragged down by the energy sector. And Nasdaq there also down 0.5%, losing about 60 points on the day as well. Let's check in on the Treasury market after that Fed rate announcement of a 25 basis point hike. We're seeing that flight to safety here. The 5-year, as you can see, they're down almost 2% on the day. The 10-year also down about 1.5%, and the longer-term 30-year yield also down there about 1% as well. All right, well, let's start off with a look at the malaise affecting markets. Today's early trading capping several weeks of drama. The Fed sticking with a rate rise despite instability in the banks. Here with more is Yahoo Finance's Ines Pare. Hey, Ines.
Hey, Rochelle. Yeah, and just taking a look at our Wi-Fi Interactive, it all says it right here. You're looking at bank stocks right now that are lower. As you had mentioned, Deutsche Bank down more than 6%. Concerns over the credit default swap prices that have really skyrocketed. That's insurance in case of a default. And so that is causing this stock to be lower. Also, the banking stocks in general. I mean, I'm just going to pull up a 5-day chart so you can see over here on the 5-day chart. These are the big banks, the regional banks. Over the last 5 days, we're looking at a mixed picture there. But if I pull up a sector action over the last 5 days, you can see financials underperforming, utilities there as well underperforming. So the big risks have been, of course, with the banking sector, with the worries that we've had there as far as banks having to stem outflows of funds. You've had First Republic that has been very volatile as far as that stock is concerned over the last week. Also, I want to mention that we got some data from B of A about total credit and debit card spending. That's been slowing on a year-over-year basis since the start of 2023. Now, this doesn't bode well for the economy, which is very consumer-driven, and it doesn't bode well for equities as well. I do want to point out what's been happening with energy stocks as well. This week, we are seeing energy stocks lower. You're looking at energy down more than 1.5%. Last week also, you saw a drawdown when it comes to energy stocks. And remember that this was supposed to be the sector that this year was going to also perform well, perhaps not as well as last year when you saw XLE up 57% for the year, but still supposed to bode well. We'll see how the rest of the year fares out. But of course, concerns of a recession is also putting an impact on oil prices, on energy stocks. In fact, XLE right now is on pace to have its biggest decline for the quarter since 2020. So it all says it right there. Also, oil, the underlying commodity, on pace for its biggest quarterly decline since the first quarter of 2020. That's when demand was totally wiped out because of the pandemic. So those are some of the risks that we're seeing in the markets right now. I do want to note, there was a note from Wells Fargo analysts saying that stocks all week, they sort of yo-yoed, and portfolio managers have preferred to go into the tech sector for safety during times of uncertainty. Rochelle.
Certainly lots for investors to take on at the moment. Thank you for breaking that down for us, Ines. All right, let's take a deeper look now at what's driving the market gloom after yesterday's rate rise. The banking sectors, as Ines was mentioning, those difficulties showing how higher rates are having unintended consequences. Here with a look at how sectors are affected and how to play it safe. Paul Karger, Twin Focus co-founder and managing partner. Paul, good to see you here. So obviously a lot for investors to digest. You have the 25 basis point rate hike. You have core PCE still sticky, a strong labor market, and of course this nervousness in financial markets from all this banking falling roll out. What are you focusing on in terms of the biggest primary risk that your clients are asking about?
Sure. Great to see you, Rochelle. Thanks for having me. I think today the real challenge is the Fed seems to be in a bit of a bind. They're really trying to grapple with increased rates and, as you put it, the unintended consequences that's had on various sectors as that kind of rolls through the economy from commercial real estate and banking and so on, with the risk of inflation. And, per Powell's most recent comments on March 7th, they're really going to take it meeting by meeting, and ensure it's really data driven.
And I mean, part of that, we saw that Treasury Secretary Janet Yellen called for an unscheduled meeting of the Financial Stability Oversight Council this morning. A lot of people wondering sort of when some of these repercussions are going to work their way through the economy as well as markets as well. Do we have any insight yet about how long some of these repercussions might last?
Sure. Great question. It's going to take time. At this point, we believe the banking crisis is all been but mitigated by the Fed and the U.S. government and central banks actually around the world. They've come out and really backstopped these banks, perhaps at the risk of inflation, but nonetheless backstop them, trying to instill confidence in the economy. But it's going to take some time. At this point, it's really about confidence, and it's a perception issue, as we're seeing in the banks today. Higher rates are having a material effect on the economy. There's no doubt about it. Banks are bringing down leverage ratios and cost of financing projects are increasing. There's also the risk of companies that have debt rolling over, that they may have financed at significantly lower rates a few years ago. So the banks are going to have to work through this, and it's going to take time as it rolls through the economy.
So let's look for opportunities here. Obviously, for the road ahead for the Fed, it could be a pause, it could be a pivot, or leaving things unchanged. What do you do in terms of portfolio allocation when you're trying to sort of look down the road at each of these three scenarios?
Sure. We're really trying to encourage clients to really maintain this longer term view and really focus on those sectors that are providing kind of secular trends and try to avoid the timing risk. For more conservative exposures, we're really skewing towards an overweight in the U.S., kind of market weights in Europe, and an underweight to EM, the emerging markets, given growth and geopolitical concerns. In the U.S., we're focused on defensive and kind of inflation-sensitive sectors, things like consumer staples, which historically have provided exposures at kind of lower volatility, lower beta to the broader market. While they've lagged on the year to date, relatively they outperformed in 2022. Another sector we really like is utilities. Utilities again have lagged on the year to date, but have really outperformed in 2022, providing lower volatility, a higher cash flow component, and then of course healthcare, less cyclical. And really benefiting from the secular trends in demographics and kind of tech, the innovation and technology within the healthcare sector. Another sector we really like is energy. And we're using the most recent volatility to, again, focus on these longer term trends and to kind of pick off some of these energy exposures at this point.
And Paul, in terms of equities, what do you like right now and what are you steering clear of?
On a day-to-day basis, you mentioned technology and how portfolio managers are finding refuge in tech names, perhaps because tech and biotech has so been beaten down. So we do like tech. We don't get into naming individual securities at Twin Focus. We're really focused on kind of more macro allocation. But, again, we're looking to build exposures to these secular trends where we have weakness. We also like, on the fixed income side, obviously there's been a big push for clients pulling out of banks, as has been overly discussed here, where federal government is effectively competing for depositors and providing higher rates. So clients have certainly flocked towards treasuries, short-term treasuries. We think the risk there is that in a potential deflationary environment in the future, you could see rates come down and you have a reinvestment risk. So you may be able to lock in a 5.5% treasury for the next year, but we're encouraging clients to perhaps look a little bit further out in the curve.
So then as you look at investor behavior at the moment, though, does it seem as if they're more so bracing for a pause at the next Fed meeting versus a pivot or anything else?
It's our feeling that Powell is going to continue to want to stomp out inflation. Again, it's going to be very data driven, but that's really kind of the signal that he sent to the market.
Well, they do seem to be listening today. Still seeing some negative action there for the major indices. Paul Karger, thank you so much. Twin Focus co-founder and managing partner. Thank you for joining me this morning. Right, shares of Activision Blizzard seeing a jump this morning on positive news overseas. A UK regulator announcing it no longer believes Microsoft's plan to purchase the video game company poses a threat to competition in the console gaming space. But it's not yet a done deal. The $75 billion acquisition still faces legal opposition from the US Federal Trade Commission. We're keeping an eye on that, but at least for now, the stock up more than 4.5%. All right, coming up, concerns rising around TikTok's web trackers and the type of data they collect. But are we focusing on the wrong things? We dive into the latest next. TikTok CEO Shou Chew testified in front of the House Energy and Commerce Committee in Washington. He vigorously defended charges from lawmakers who claim that TikTok is a Chinese tool to spy on Americans and spread misinformation.
We have heard important concerns about the potential for unwanted foreign access to US data and potential manipulation of the TikTok US ecosystem. The bottom line is this: American data stored on American soil by an American company, overseen by American personnel.
It was Chew's first time testifying on the Hill, and in a high-stakes showdown, he was grilled in a hearing that lasted over 5 hours.
Have any moderation tools been used to remove content on TikTok associated with the Uyghur genocide? Yes or no?
We do not remove that kind of content.
What about the massacre in Tiananmen Square? Yes or no?
That kind of content is available on our platform. You can go and search it.
I will remind you that making false or misleading statements to Congress is a federal crime.
The vast majority of our users come to our platform for entertaining, safe content. But there are people who do spout some dangerous misinformation, and we need to take that very seriously, invest in it, proactively identify it, and remove it from our platform.
You gave me only generalized statements that you're investing, that you're concerned, that you're doing more. That's not enough for me. That's not enough for the parents of America.
Why did an internal memo from TikTok corporate headquarters explicitly coach senior management to, quote, downplay the parent company ByteDance?
Congresswoman, I have not seen this memo.
You can't answer that question.
You spoke in your opening statement about a firewall relative to the data. But the Chinese government has that data. How can you promise that that will move into the United States of America and be protected here?
Congresswoman, I have seen no evidence that the Chinese government has access to that data. They have never asked us. We have not provided.
Well, you know what?
I
find that actually preposterous.
You know about the blackout challenge. You know about the NyQuil chicken challenge, the Benadryl challenge. Why is it that you allow this to go on? We've already heard, God bless you, from parents who are here with us, who have lost children.
This is a real industry challenge, and we're working
No, it's
very
not
hard.
industry. This is TikTok.
Shou Chew didn't convince lawmakers on either side of the aisle that TikTok is not a threat to US national security or that content moderation is being taken seriously enough. Now, Chew came up here with the mission of turning down the heat on TikTok, but instead that mission seems to have failed. The calls to rein in the app or ban it altogether are now only intensifying. Well, those are some of the concerns there around TikTok's web trackers and the type of data they collect. We're seeing those on the rise. But what risk is there with these trackers, and what other threats does the TikTok app pose to users? Joining now to weigh in is ad tech firm Mountain President and CEO Mark Douglas. Good to have you on the show, Mark. In terms of what lawmakers were focused on, we did see a lot of this focus on the trackers. You say they're looking at the wrong thing or focusing on the wrong thing.
Yeah, I think it's important to understand there's essentially the trackers are a small piece of code that exists in websites, essentially just to know how many people have visited the website that might have seen an ad in the TikTok app. What the lawmakers were focusing on a lot was the app itself. And there are very different concerns in that. We know from the Twitter files that every major social media platform was cooperating with the US government. So there's absolutely no reason to believe that TikTok would not be fully cooperating with the Chinese government. So that's serious concerns. The trackers, on the other hand, there's no ambiguity there. So the code for the TikTok tracker is visible on any web page. If you go to any browser, Chrome, Safari, there's a menu called Developer Tools. If you select from that menu, you can see exactly what TikTok is doing. And so there's no like ambiguity or there can be no concerns. You could just literally see what's happening. The other thing about trackers, these were covered. If you remember a few years ago, there was a lot of concern over cookies. So all of these browsers put trackers into what's called a secure container, and they're limited in what they can do, what they can access. So I think the focus on trackers is a bit misguided. It would actually be TikTok's best case scenario if everyone got focused on the trackers and stopped focusing on the app, because there's no concerns and they get very little value from them.
And we see Google and other companies doing the same thing as well. Now, you say that the real big issue is the app itself. So what is it within the app that you think poses the biggest risks?
Well, a lot of concern, again, is over the data. And people say, what's the data? It's just a innocuous video. But, TikTok does have your location, especially if you use any of the tools to post anything on TikTok. The moment you post, it knows exactly where you are. It's an open mic, it's an open camera. And so there are legitimate scenarios, I don't think for the average American, but for some people, certainly politicians and others, where that information they may not want shared with the Chinese government. And so it's these scenarios, I think, to be concerned about. Probably, again, not the average consumer in TikTok. The concerns over the content of the app, well, that's just covered by U.S. law, freedom of speech, and things like that. But I think you have to put yourself in the mindset. If you were given a device by any foreign government, Chinese government, any foreign government that could record video, record audio, and know your location, would that be something you would want to give them? And that's literally the question. And that's a question that I think Congress and kind of the president of the White House, essentially, that's a question that they need to answer, and they're going to have to answer in some way.
And we did hear one of the lawmakers bring up this issue that even if you don't have TikTok, say someone shares a TikTok video with you or something like that, that TikTok would still have access to that information. So from a user perspective, what should people be aware of if they don't have the app?
Well, again, I think it's like this scenario. What if you were one of those the people in that hearing, their kids probably have TikTok. And so again, it's kind of spy novel level stuff, but it's the information being emitted by the app. You have to assume that information is going straight to the Chinese government. And I know the president of TikTok, kind of tried to downplay those concerns, but I feel like once the Twitter files came out, like we know that all of these platforms are cooperating with governments. So there's just no doubt. And so it's not something that's like, what's the specific content being recorded? It's the app itself. And I think actually Apple and Google can play a role here. They created secure containers for the trackers, and they can be called on also as to what kind of security in the apps, as to what data is being recorded and things like that. And then ultimately, just even storing data on U.S. soil doesn't prevent a copy of that data from getting, outside the U.S. And it doesn't prevent the Chinese from accessing it on U.S. soil. So these are complex questions, and they're going to take some time. They're almost military level concerns. So it's an interesting topic to watch.
And we certainly see this is one of the few things where we're seeing bipartisan cooperation on a topic. But I want to talk about sort of the broader issue for social media companies. We did see some of the social media stocks getting a boost, as essentially Shochu seemed to sort of dig himself into a hole by not presenting sort of yes and no answers to lawmakers. What should we be looking at in social media stocks? Because we did see some of these copycats when India banned TikTok, and we still saw some copycats pop up with the same issues though.
Well, I think that's a little bit of wishful thinking on the part of investors. Banning an app in the U.S. is going to be very difficult. I'm not obviously a lawyer, but I think the app would have to be categorized as a munition to even consider it. So I don't think you're going to see TikTok go away anytime. I think it's possible that it's in TikTok's interest to cooperate with the U.S. government in some way, and so maybe to kind of calm down some of these concerns. But the idea that TikTok is going to go away and Instagram and Meta are then going to, kind of thrive with TikTok out of the way, I think that is far-fetched in the United States. It's just our laws are just not really set up to just ban products outright based on concerns without those products having some connection to military use. And that I don't think that's really it's a scenario here, but it's not really on the table, I think, in terms of the conversations.
Certainly there's some knowledge there for investors to keep an eye on, perhaps not to get their hopes up too soon.
Yeah.
Talented President and CEO Mark Douglas, thank you for joining me this morning. All right, checking in on the markets here, sponsored by Tasty Trade. We see still in negative territory, a bit of that selling action picking up though. The Dow there now off more than 220 points, down 0.7%. The S&P 500 they're also losing ground, down 0.7%, about almost 30 points there. And the Nasdaq as well, also seeing the strongest losses on the day for the major indices, down 0.92% there, or 109 points. All right, coming up, Netflix shares in rally mode as the streaming giants turn its attentions to a new product. We'll discuss next. Netflix shares higher after upbeat news surrounding the streaming giant's various revenue initiatives. Yahoo Finance's Ali Canal joins us for more. Hey, Ali.
Hi, Rochelle, and that's right. Netflix leading the S&P 500 on Thursday with shares closing more than 9% higher after a big rally that we saw in the stock. Shares leveling out a bit today, up about 1.4%, but still trading to the upside following those huge gains. It was not immediately clear what was driving this rally yesterday, but it all seems to stem back to positive data surrounding the company's password sharing crackdown in Canada. And according to Yipit data, that crackdown crackdown did not have a material impact on churn. In fact, gross additions in Canada actually improved. Wells Fargo out with some new estimates following that report, saying if Netflix added 10 million extra Canadian members at an additional $8 a month, plus 5 million additions at $15 a month, that would lead to a $2 billion upside in revenue at the high margin, which is what Netflix wanted. They really wanted to improve that top line number, improve profitability. In addition to the password sharing crackdown, we've also seen recent reports that their ad-supported tier is doing really well. Bloomberg reporting earlier this week that the ad tier reached roughly 1 million monthly active users in the US in those first 2 months, bucking earlier reports that the ad tier was actually struggling. So that's been positive. The fact that we've seen a lot of analysts on Wall Street reiterating their buy ratings, their outperform ratings, encouraging investors to jump into this stock has also led to some momentum. In addition to the fact that Netflix seems to really be doubling down on its gaming strategy. So once again, just multiple revenue initiatives here, and all of that really helping sentiment heading into the next earnings season. Netflix will report Q1 earnings on April 18th. So hopefully some more details surrounding all of these strategy plays and more specifics on how Netflix thinks all of this could play out and help the stock in the future.
It's interesting to see how low that churn is, because, you know, social media was sort of all ablaze as to what would happen, people saying they would quit Netflix. Doesn't seem to be the case, at least for Canada for right now. And Ali, there's also some news from the FTC that they proposed a rule that would make it easier for consumers to cancel free subscriptions. What more can you tell us about that?
Yeah, so the FTC proposing this new regulation, which essentially would ban companies which use deceptive, lengthy, cumbersome measures to have users cancel a subscription. We all have been there. I know personally for me, I've been offered 3 months of free Apple TV Plus with my phone subscription, but I know in the back of my head I'm going to forget that's there, and then they will keep charging me for that. So essentially with this new ruling, customers will be able to cancel the same way that they signed up for a particular service. And look, streaming obviously affected by that with all of the major companies that we have, so many options on the market. We know this has been a frustrating point for consumers, a pain point for consumers moving forward. So perhaps this is one way that customers can, you know, really address this head on and not have to deal with lots and lots of fees over time, because we know that the industry is heading in a place where we're going to see some consolidation. Consumers are already being more picky, more choosy in the services and the platforms that they choose to subscribe to. So I think this is another development in that process and how we're going to see, you know, a more picky consumer moving forward.
It certainly does keep evolving this space. I usually just do the calendar reminder, but I've been caught out plenty of times with those free subscriptions as well. A big thank you there, Ali Canal. Thanks so much. All right, coming up, layoffs in the tech space have continued well into 2023, but how will this impact the sector moving forward? We'll break it down for you next. Layoffs in the tech space continue, with over 150,000 workers across the industry losing their jobs thus far in 2023. But the approach in reducing headcount may lead these tech companies into future hurdles among employees. Here with the do's and don'ts for job cuts is Yahoo Finance's Ali Garfinkel. Ali, the right and wrong way to do this?
There is indeed a right and wrong way to do this. And as it turns out, tech is doing this the wrong way. So there have been a couple of key ways that have been features we've seen over and over again in how tech companies are laying people off. And I'd say it can be amounted to two things. First, they're being done incredibly impersonally. For example, we'll hear about these massive Zoom calls or workers being locked out over computers. That is a huge no-no according to HR experts. And then the second is that it will happen over time. And this was the thing that HR experts actually were incredibly against. Those layoffs over time, for instance, Amazon is doing its layoffs in waves. That is also a huge, huge no. Because as it turns out, these are exactly the things you are not supposed to do when you're laying people off. So, which brings to the question is, what should tech companies be doing? What is the right thing to do? Obviously, there is no good way to lay someone off. There's no good way to fire someone. But as it turns out, there are better ways and worse ways. For example, you can actually be doing this with one-on-one conversations. And that really can minimize the harm so people feel thought of and it doesn't affect how they think about themselves moving forward. And the big thing that I heard over and over again, Rochelle, one big cut. The waves are no good. They will create instability in an environment. And if you're wondering why investors should actually care about this, I have one word for you: innovation. For these companies, innovation is everything, and innovation goes back to people. So the HR experts I spoke to for this story, I asked if there could be consequences moving forward for these companies, and they said absolutely yes. And the biggest one is that workers will grow more uncertain and less productive. The conversations actually went to places I didn't know we were going. For instance, we were talking a lot about Maslow's hierarchy of needs, for example, which is a motivational theory in psychology, and neuroscience and the fight or flight reflex. It's that primal for people. This really goes back to how people think about themselves and how they feel that they can provide for themselves and their families. So what's to be done? What could the long-term effects really entail? In this particular case, for companies that are hinging on innovation, even high performers could go. Well, a lot of them might say, hey, look, I need some stability. I've got to get out of here. But the other thing, too, is that over time, this could affect how companies are innovating and operating. If workers feel more uncertain, if they're worried about being laid off, they will be less productive. So I think that if we see companies look different in makeup or in productivity or in innovation down the line a couple years from now, it's possible it will tie back to how they are handling this moment.
And you have to think, when people are looking for jobs, they remember these big headlines of how certain companies treated certain employees and may want to steer clear. Great stuff there, Ali Garfinkel. Thank you so much. Well, Citi is resuming coverage of AMC with a sell rating, noting its common equity is overvalued at prevailing levels. Here to break this date down, the meme trade, is Jason Bazinet, Citi Managing Director. Jason, good to have you. So here we have you resuming coverage with a sell rating and a $1.60 price target. So talk about that breakdown and what you're looking at in terms of how AMC can really reduce leverage.
Well, there's really two narratives that are going on, both related to COVID. The first is, AMC had to take on a lot of debt during COVID because people weren't going to the movie theater, and they're recovering from that. The second narrative that's linked to COVID is AMC became a meme stock. And so when everyone was, sitting at home and sitting with their stimulus checks, this became one of the darlings. And the equity got very overvalued. And what the company is trying to do right now is essentially take its two classes of shares, the common shares and what are called the APE units, and combine that into a single class. That there are some legal challenges around that. But the real question for shareholders is, A, will they be able to combine it into a single class? And then B, what is the new share price going to be if they are able to combine it into a single class? Is it going to be the higher share price, AMC's common stock, valued at $4.40 a share, or is it the APE units that are valued about 1/3 as much? That's going to be the key question. If we end up with a lower, I'll call it a pro forma share price, then AMC is going to have to issue quite a few shares to pay off that debt. if they're lucky and they can raise capital with a higher common price, the $4.40, then there'll be less dilution to pay down the debt. So those are the two things: the court case, and then what is the ultimate equity value where they're going to be able to raise capital.
And another factor is going to be obviously the box office recovery. Talk about your outlook there and how that affects AMC.
Yeah, I'm pretty humble, when it comes to forecasting the box office. So we just rely on HSX, which is almost like the wisdom of crowds, and just build our numbers up. What it suggests is we're going to see a pretty decent recovery sequentially in 2023, up about 25%, but we're still going to be a couple $2 billion below the 2019 box office number. And that's just based on what HSX is saying the various movies will do. And it's been a pretty good barometer to gauge box office expectations. So a little over $9 billion this year versus the $11 billion, which is sort of a more typical pre-COVID box office figure.
And we know this does tend to be the year of efficiency, as Mark Zuckerberg coined it. But I want to talk about leadership. Talk about how you see the leadership at AMC with its CEO.
Well, they've done a fantastic job. I can't think of a company that's been dealt a more difficult hand than AMC was, just given that their business essentially went to zero for really, reasons that were outside their control. They very definitely sort of managed this entire process by, issuing those 8 units, trying to get it into a single class, and then trying to take advantage of what I would argue is an equity value that's too high to try and get their debt back under control. So they've done a very, very good job under very difficult circumstances.
And what do you see as the biggest risk? Obviously, once you start being traded as a meme stock, a lot of things can throw you off course. What do you see as the biggest risk for AMC?
Well, I think the biggest one is going to be this court case. I mean, I think they'll probably prevail. At least we're assuming that they are. I mean, their bylaws were pretty clear, but strange things happen. So that's certainly the big one. That's going to happen later on this spring. And then your second risk is just the box office, which is a little bit outside their control. It's a function of consumers' appetite to go out to the movies. We've got a pretty decent slate this year, but that certainly would be the second risk I'd be worried about if I was the CEO of AMC.
And obviously, all meme stocks aren't created equal. Are there any others that you see opportunities in at the moment?
Oh, I don't really follow anything outside my coverage universe, so I can't weigh in on that.
Fair enough. Well, a big thank you there to Jason Bazinet, City Managing Director. Thank you for your time this morning. Have a great weekend. All right, coming up, how is high inflation impacting retail investors? We talk to the head analyst from Finamize on their latest survey next. Time now for our charts of the day. New data from Redfin comparing 2023 so far to the past 3 years, showing that active listings, which is the number of homes listed for sale at any point during the period, well, those are up 15.4% year over year. This is the smallest increase in over 3 months and is still well below pre-pandemic levels. Also coming in from Redfin, showing that in the 4 weeks ending March 19th, new listings of US homes for sale fell 22% from a year earlier, making it one of the biggest declines since the housing market nearly ground to a halt at the beginning of the pandemic. Now, this is likely driven due to the high mortgage rates as homeowners are clinging to those low rates. All right, feeling out the Fed. St. Louis Fed President Jim Bullard out today with comments on the Fed's next moves and why he still sees strength in U.S. banking. Joining us now with more Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Good morning, Rochelle. We're starting to hear from Fed officials after that blackout period and the Fed meeting. St. Louis Fed President James Bullard, speaking this morning in St. Louis, says even with the bank failures, the economy is performing well and that inflation remains too high. He says he thinks there's an 80% probability that stress in the banking system abates, and we're actually left with a strong economy that could actually force the Fed to push rates higher. He says while there is financial stress right now in the system, it is nothing compared to the levels seen during the financial crisis or back in the pandemic.
The U.S. banking system remains very strong and very resilient. I would just amplify that if you look at the banking sector by the numbers, it's really in very good shape. So I think, it's something like SVB happens, which is very unanticipated, I think, even by the executives at SVB. And this was not sort of widely known, and it was very sudden. Of course, that's going to create angst and make everybody look at their business plans and make investors reassess, and that's appropriate, and that's what has happened. But I think we have the tools to handle. I think it was a quirky situation, and I also think that we have the tools to handle any fallout from it. So, and I think we've implemented one tool, which is the bank term lending program, which I think will be very successful in handling any immediate problems that occur.
Bullard says he's been talking to banks and they would describe the situation as, quote, angst, but not actual problems at the various banks. He says they're just wondering if deposits are going to be as sticky as previously thought. They're also wondering about disintermediation and whether these deposits are going to continue leaving the banking system to go elsewhere as people are seeking higher yields. He said, as you heard in that SOT, that Silicon Valley Bank was a very special situation, and most banks are not anywhere close to that situation. Bullard said regulators' actions were swift. They were the right action to take in the wake of SVB and Signature's bank failures. He underscored what Treasury Secretary Yellen said, that regulators stand ready to take additional action if needed. Bullard also noted that economic data have been stronger than expected and that we've seen episodes with banks back in the 1980s and 1990s where the economy emerged unscathed. Bullard said that the financial markets reaction here, the fact that we're seeing Treasury yields actually come down a bit, could mitigate some of that stress by offering lower borrowing costs. Rochelle?
And Jennifer, the Treasury Department is saying that it will convene an emergency meeting of the Financial Stability Oversight Council sometime this morning, but has been quiet on the details. What do we know so far?
Rochelle, I don't know if we would characterize that as, quote, an emergency meeting. The advisory we got last night that there is going to be an FSOC meeting this morning. I'm sure regulators right now, we don't have much information on it. We would expect somewhat of a readout later this afternoon. But I would note that it makes sense that regulators are meeting right here on this right now, right? We're seeing still a lot of stress in the markets. You're seeing shares of Deutsche Bank really sell off. People are taking out insurance. You're seeing the swaps prices on that really skyrocket. So there's still a lot of uncertainty, a lot of fear in the markets, and that obviously presents and sets the table for the potential for contagion, even if underlying problems perhaps aren't as bad as what markets fear. Right now, markets are just trying to snuff out all of the weaknesses that could potentially be across the banking system, whether domestically or overseas.
Indeed, certainly investors hoping to get some stability here. We'll see what comes out of that meeting. Jennifer Schonberger, thank you so much. Well, retail investors are aware that inflation remains stubbornly high, so they're loading up on long-term assets to build up their position in the stock market. This, according to a survey from Finimize that showed 68% of investors polled think the global stock market will be higher a year from now. Well, for more on this, we welcome in Carl Hazley, Finimize head analyst. Good to see you, Carl. Obviously, this has been quite a turbulent time for retail investors when you compare it to the record inflows we saw in February. I believe 1.5 billion daily through February, according to your data. Where are we now once they sort of factor in things like the banking crisis?
Thank you for having me on, Rachel. Maybe to set the scene, after a tumultuous 2022, we had a very optimistic start to 2023. And if you fast forward to today, we're in the middle of a banking crisis amidst other uncertainties in the macro space in particular. And what retail investors are doing right now is exactly what professional investors are doing at the moment right now, which is actually taking some risk off the table and taking their foot off the gas.
So with that in mind, then, what are they doing? What's the outlook then for the next 12 months for some of these retail investors?
Yeah, great question. So our data shows that about 2/3 of retail investors are sitting on somewhere between $5,000 and $50,000 worth of cash right now. But as you said up top, a significant proportion of these people are expecting stock markets to be higher 12 months from now. So over the longer term, they are optimistic, but given the uncertainty at the moment, they are looking for a more attractive time to start to buy back in.
And we were looking at meme stocks earlier in the show. It's interesting because in your data, it says that only 5% invested in meme stocks in the last 3 months. What is it that they're considering then when they're sort of trying to address whether or not to jump into meme stocks?
So meme stocks are really interesting because actually, if I go back 3 months to our previous survey, only 15% of modern retail investors said they had ever invested in a meme stock at all, right? So 85% of them hadn't. And fast forward to now, only 5% in the last quarter have invested in meme stocks. But that makes sense in the context of, the uncertainty that's out there right now and people taking their foot off the gas and risk off the table, in that retail investors are buying fewer single stocks because of them taking risk off the table. They're looking more towards ETFs when they are investing, and they're looking more closely at fundamentals.
And so with that in mind, we're seeing only 25% plan to invest in Tesla, favoring Apple. Apple is usually sort of the market favorite here. What are some of the top picks for retail investors for some of these mega cap names?
Yeah, that's right. So Tesla, I think if you look at how it's performed this year, it's had a fantastic start to the year, and the share price has maybe stalled a bit. And compared to where, how the risk reward in Tesla maybe looked earlier in the year, that's perhaps not quite as favorable from a retail investor standpoint. And that could explain why they're shying away from Tesla and in favor of Apple. Where else they're interested in? Big tech is still interesting. Despite last year being tough in the big tech space, we're seeing a lot of them cut costs, right-size their staff, and focus a bit more on profitability, which, again, retail investors think, okay, well, in this environment, actually, that could be quite exciting.
And so then, because for these retail investors who perhaps don't want something as risky, is that why we're seeing not as much interest with AI investing, despite what we've seen with the popularity, at least in the headlines, when it comes to things like ChatGPT and OpenAI?
Yeah, I think there are two interesting things on that. I think the first is that about a third of our respondents said that they are considering using AI in their investing. So I think it shows you how far the likes of ChatGPT have to go in really being able to support that investment process. But on the other hand, the technologies that AI will enable are super interesting to retail investors. And so the likes of NVIDIA, Microsoft, Alphabet, to name some of the biggest, are super interesting and getting a lot of attention from our retail investor audience.
And they do seem to be quite optimistic about the year ahead. Are they being too optimistic at this point, given that there are still so many unknowns about where the Fed is going, how long the banking crisis is going to continue to reverberate? Yeah,
look, there are lots of major uncertainties out there. But I think the optimism is underpinned in two things. First, there's a lot of cash on the sidelines, not just retail investor cash, but we've seen recent survey data showing institutional investors pulling cash to the side. So that money will likely come back into markets over time. And the second is the advantage that retail investors actually have, which is they can be really long term, right? They don't have an annual benchmark to hit. So they can afford to think beyond just this year and think multi-years into the future, and therefore be optimistic about the direction of markets over time.
We'll certainly continue to keep an eye on retail investor activity. Carl Hazley there, Finami's head analyst. Thank you for joining me this morning. All right, coming up, we'll check in on the markets ahead of our noon hour and get you set for what to watch for the rest of the day. Stay tuned.
Change up in the Starbucks C-suite. Laxman Narasimhan is the new CEO of Starbucks. Lax, as baristas know him, already set the tone on how he will lead, spending the last 5 months visiting stores, manufacturing plants, and support centers around the world. So what do we know about the first external CEO of one of the world's most popular coffee chains? The 55-year-old executive was born in Pune, India, where he earned a degree in engineering. He then attended the University of Pennsylvania and received a master's degree in international studies and business administration. He's a Verizon board member, a member on the Council of Foreign Relations, and a trustee of the Brookings Institution. Lax started his career at the consulting firm McKinsey, where he spent 19 years becoming a senior partner. He served as a global chief commercial officer of PepsiCo before joining the London-based company Reckitt Benckiser, the parent company of Lysol. Laxman was credited with boosting sales during the COVID-19 pandemic and led the company through the baby formula crisis here in the U.S. with the Enfamil brand in its portfolio. Over the course of his 3 years as Reckitt CEO, investors saw the stock rise 8%. The reason he left that top spot? Starbucks. Narasimhan takes the helm in what former 3-time CEO Howard Schultz calls a new era for the company. That new era will likely include working with union organizers, Starbucks' growth strategy, expansion into China, and the rollout of its new olive oil coffee line, Oleato. And the stakes are high. Investors hope Lax's global perspective could drive growth in both mature and emerging markets for the coffee chain.
As I look at value creation,
This is the model that is core to the value creation model of the company. And if you do it right, the opportunity set is limitless. And I know what it will lead to is outsized returns for our shareholders.
And you may be wondering, what is his favorite drink? Well, one that will keep you going. A Doppio espresso macchiato with hot skim milk on the side.
We've got a lot on tap for you here on Yahoo Finance this afternoon. We'll be covering the aftermath of the TikTok hearing on Capitol Hill, breaking down everything from the teens' use of the platform to what a ban could mean for other social media stocks. And Manchester United has been on a wild ride this year, as sale rumours have been driving volatility in the stock. Steve Olenek, Mint's chair of the sports entertainment practice, will be in studio in the 4 p.m. to tell you what a potential sale means for shareholders. Well, before we go, let's do a final check of the markets. We're still seeing them in negative territory, but at least some of that selling action slowing down here. As you see significantly, the Dow, they're now just down about 28 points. It was down about 200 points just about 20 minutes ago, down about 0.1%. The S&P 500 also down about 0.1%. The Nasdaq down about 1/3%. We've seen that banks have been dragging on the Dow, Amazon, Nvidia, and Tesla dragging on the Nasdaq, and we're seeing consumer discretionary and energy weighing on the S&P sectors this afternoon as well. Well, that'll do it for now. I'm Rochelle Akufo. I'll be back Monday at 11 Eastern. I'll see you then.